Right, so welcome back. We're doing chapter 6 now. Can you give me a green check mark so that I know everyone is back? I'm going to jump into our new chapter, which has some new types of income. So not just employment income, but now we're starting to get into a few other sources of income and therefore a few other types of tax slips. Again, for this class, I'm going to do a little more talking than I like to do. I try to make sure it's as interactive as I can, but we have a lot of details to go through, partly because, again, COVID made our lives a bit more difficult. So some of the sources of income we're going to talk about today are related to what happened when we started getting COVID benefits. So there's a lot of new things. Okay. But I want to start with what is a little bit less complicated, which is some social assistance. We have a slip called the T5007, so T5007, T5007. Again, all of your clients are going to call all of their slips T4s. Everyone says, I don't have my T4 yet, and they mean this. That's perfectly fine. I tell my clients, bring me everything with a T on it, and I'll figure it out from there. What you're missing on this slip, if you're in Manitoba and you see a T5007 slip, we're going to have an extra box. So for Manitoba particularly, I want you to be aware of the fact that these slips are going to look different. Our T5007s have a box 14, which is going to be off to the right of the box 13 here. And that is a crucial box number. We'll talk about it when we talk about social assistance. Okay. This slip is used for two types of benefits. It's used for workers' compensation and for social assistance. Both types of benefits are reportable income. They have to go into total income because they are used when we calculate benefits. So they go into net income, but they're not taxable. And so what you're going to see is whenever you have a T5007, you have two line numbers on the tax return right away. You have an income number and a deduction number. And again, the deduction is going to come off after net income. So a lot of our clients get stressed when we start putting money on the income line because they know it's not taxable and they don't want to pay tax on it. And you can reassure them, it's not taxable. It has to go into the tax return to calculate net income, but it's not taxable. Let me show you. I'm taking it off again. So you show them on the tax return where it's coming off. Okay. For workers' compensation, there can be some complicated things that happen when workers' compensation is delayed. So the way you get workers' compensation is you have a job, you work at that job, and in the course of your work you are injured, and then you apply to the Workers' Compensation Board, which is a special government organization. The employer has to pay into it for all their employees, and the Workers' Compensation Board will say, yes, because you were injured while you were at work, we will cover your costs while you are recovering from your injury. Okay? And again, it is not taxable. So this is different from disability income, which if the disability income is coming from an employer-paid plan, is generally taxable. Okay? So workers' compensation comes that way. It is reported in box 10 of the slip. It's not taxable, so we're going to put it on line 14400, and then we're immediately going to take it off again on line 25000. It can get tricky if the employer was paying the employee while they were waiting for workers' comp. So sometimes you'll have a scenario where the employer will pay or the disability plan for the employer will pay, and that might be taxable income. And then workers' compensation will think about whether or not they're going to cover them. Later on, they are going to cover them. They go, okay, fine, yes, we'll cover you. And in that case, they will pay money, but they won't pay it to the employee because the employee already got paid money by the employer. They'll pay it directly to the employer. In that case, you're going to have a T4 Box 77. And what that does, if you see a T4 Box 77, you get a deduction, because essentially what you were paid before, you've already paid tax on, and you shouldn't have paid tax on it because if it had been workers' comp, which it should have been, it wouldn't have been taxable. So that's why you get a deduction. That's the easy one. If you get a T4 with a Box 77, claim the deduction. The really messy ones that happen later, which is what happens if part of it's repaid, part of it isn't repaid. There's a whole scenario that can happen. That would be something we cover in an advanced course. So that's beyond what we're going to do for today. All you need to know is if you see workers' comp, put it on, take it off. If you see a T4 with a box 77, give your client the deduction. If you run into one of these other messy scenarios, you're going to know that it's messy because your client will come to you and tell you, I have a really messy workers' comp thing happening. And if it's anything more complicated than this, you're going to go find a senior associate to assist you. Okay? Any questions about workers' comp? It's pretty easy. The important thing is remember the deduction because it's not taxable. Okay, social assistance is the one that gets a little bit trickier. Only for us. Only in Manitoba is it a bit trickier. It is reported in box 11. It is assistance that you get while you are not able to work for various reasons. Might be because you have young children at home you have to look after. Might be because you have a disability that isn't covered under a different disability plan. Lots of different reasons. It's not taxable, but it's included in net income. So again, it's going to go on line 14500, and then it's going to come off on line 25000. The tricky bit that is true for everyone, so whether you are in Manitoba or elsewhere, social assistance, if it's paid while you're living with a spouse or common law partner, doesn't matter whose name is on the slip. And Karina, is social assistance the same as EIA? Usually EIA is paid through social assistance and they will receive a T5007. Okay, so some EIA will be covered under this slip. Okay, so social assistance, if it's received while you're living with a spouse or common law partner, it must be reported by the higher net income spouse or common law partner. So if you have two spouses and they're both receiving social assistance and they both have some other sources of income, you're going to have to look at both of their returns, find out whose net income is higher, and then put all the social assistance on one person. Workers' comp is different. Workers' comp, whoever got the workers' comp, it's their income. Social assistance is for the family. Okay. The tricky one, and the one we have to deal with in Manitoba, is that box 14. So that box 14, which will be right next to the box 13, is going to have a number in it between 0 and 1. And it might be a fraction. So often it'll be, 1 or 0.0, or it'll be 0.0, or it might be 0.3, might be 0.7. It will be a fraction. And that is because in Manitoba, they will already receive their refundable Manitoba credits. So that basic personal amount we talked about and anything related to that, they get paid that up front as part of their social assistance payment. And so we have to reduce the amount of their refundable credit by the percentage of the number of months that they were on social assistance. We don't really need to calculate it. We just need to actually look at the slip and make sure that it gets on the line. So I want to show you what that looks like. I'm going to pull up a tax return now. Okay. And I'm going to go into my refundable credits because this is on the refundable credit form. So if I go into my MB479, if it wants to load for me and I make it nice and big, you're going to see you're going to calculate your personal tax credit based on your family scenario. So remember, if we're dealing with a family, this is going to be connected to the person who's reporting the social assistance. It's all going to go together in one place. We're going to take that and we're going to calculate whatever additional personal credits we're getting here. We're going to come all the way down to line 65. And this is where we have to remember to factor in that they may have already received some or all of their personal refundable credits. So you're going to take their whatever's left of their refundable credits when you get to this part of the form. And then if you or your spouse received the T5007 from Manitoba, you are not eligible unless box 14 contains a fraction. So if it's blank, you're not eligible, but in Manitoba, it's never blank. It will have a number in it. Okay. If there's no fraction, it's a 0. If it's a 0, it's a 0. If there's a fraction, it's a 0. If it's a 1, you get to keep your credits, but it's only a 1 if you weren't on social assistance for most of the year. Okay. So you might have gone on social assistance right at the very, very, very end of the year, in which case you might have a 1. Generally speaking, we have to prorate it if it's a part year, or it's 0 if they were on it all year. Okay, you're going to take whatever the fraction is, and you're going to multiply by the personal credit, and that's going to tell you how much you're going to get. So Manitoba specific, but very important that you think about it. If you're doing refundable credits and you have a T5007, come back to this and remember that you have a special thing you have to do. There is information in this in the provincial supplement, but it's a little bit hard to find. So if you look in the provincial supplement and you search for social assistance, you're going to find the paragraph that deals with how to do this. Or just make a note in your own notes. Remember line 65 of your refundable credit form. Social assistance, remember line 65, and you'll be fine. Okay. This is not going to be on the slides that are downloaded because I added the Manitoba specific piece, so you're going to have to make sure you have a note of this for yourself. Okay, any questions? So workers' comp, the person who got the workers' comp claims it, and it goes on the return and off the return, and you're done. Social assistance goes to the higher net income spouse, goes on the return and off the return again, and then in Manitoba, look for the box 14, and make sure you factor that in when you're calculating your refundable credits in Manitoba. Okay. So we've talked about employment income, we've talked about social assistance and workers' comp. You can also receive income through Canada Pension Plan. So we've been talking about paying into Canada Pension Plan. Now I want to talk about getting money out of Canada Pension Plan. So what happens when you receive money from Canada Pension Plan? Well, you get a tax slip. And it's a slip called the T4AP. So it's a T4A Statement of Canada Pension Plan Benefits. It has important boxes at the top, and then it has a breakdown of those boxes down the side here. So it'll always tell you the tax year, the name of the person receiving the money. It'll give you a total. So box 20 is going to be the total of boxes 14 through 19. It'll take all of those and add them together. That goes in box 20. If they were on CPP Disability, it will tell you how many months CPP Disability they were on. Why is that important for us? What do we need to think about if you see anything in there? If what they're getting is disability. If they have a job and they're paying in CPP and they were receiving CPP Disability, what do we have to do on the Schedule 8? If you are collecting CPP Disability, you cannot pay into CPP Disability. So that number might be relevant if you notice that what they are getting, like this person, is a disability benefit. So this taxpayer is receiving a disability benefit for the whole year, so they will not be able to pay into CPP. If they have been paying into CPP, they are going to get it back. It will be refunded because they're not eligible to contribute. Now, sometimes that number is not relevant because it's not a disability benefit. If it's a retirement benefit, if it's any other benefit, we don't need to prorate. But if it's a disability benefit, we need to know that number for prorating. Excellent, good. So if they were retired, it'll tell you that they were retired, but we don't necessarily need that number because it may not be relevant. Remember, you can retire early and elect to keep paying into CPP. That is an option. All right, box 22, if you paid into CPP, they might have taken tax off. They don't always take tax off if you're receiving CPP income, but they can take tax off. If they did, they'll give you a box 22. Where will that go on the tax return? Step 6, perfect. So just like you had a box 22 on your T4, tax already paid, this also accounts as tax already paid to the government on your behalf. They will have a social insurance number and they will tell you the effective date or onset date. So again, if you started collecting CPP Disability mid-year, they'll give you the exact date that you started receiving it, so that can be valuable. Good. And then again, down the side, we have different types. We're going to talk about that in more detail. Essentially, box 20 is going to go into income on the CPP income line, and box 22 is going to come off on the tax withheld line. How do you get CPP? Well, if you retire and you're eligible, you can start claiming CPP. That's called the retirement benefit. How do you get the survivor benefit? How do you get a CPP survivor benefit? What happened? If I'm receiving a CPP survivor benefit, what happened in my life? My spouse was eligible for CPP and they died. So it means that I had a spouse who was eligible or collecting CPP and they died, and I'm going to get a portion of their CPP. So that's the survivor benefit. Disability benefit, if you qualify for it, you apply and you say, I'm disabled and I need to take my CPP out now. And if they agree with you, they give you the CPP disability benefit. How do you get the child benefit? How do you get the CPP child benefit? If your parent who was collecting or eligible for CPP dies and you're their child, you might get a benefit. Okay. The death benefit, we have to be careful about. The death benefit is a separate benefit you get it's about $2,500. You can apply for it if someone dies. It covers funeral costs. That one, if you see you want to go get someone who knows what they're doing with deceased returns, death benefits are notoriously reported in the wrong place. So death benefit, it means someone died that year. If someone died that year, go find a specialist to help you with the return. Okay, I'll tell you, even the CRA gets confused when we start dealing with CPP death benefits. So if you see a death benefit, it is something that you apply for if someone died to help cover funeral costs. It's $2,500, and it has special rules for how it gets handled on a tax return. Go find a specialist. The post-retirement benefit you're going to see all the time. You get the post-retirement benefit if someone's retired, they've started collecting CPP because they're old enough to collect CPP, but they want to keep working. So while they're collecting CPP, they're also paying into CPP. And while they're paying into CPP, they're still collecting CPP. That extra portion they're collecting is called the post-retirement benefit. Okay. It is possible that you can apply for CPP, especially CPP Disability is the one that we see the most often. And they can take a really long time before they decide if they're going to give it to you. And then they do, and they give it to you as a lump sum. And the problem with that is you have to report CPP in the year you receive it. And that can really be not great if you get 3 years worth of CPP all as a lump sum, because it can bump you up a tax bracket, and that can be a problem. So there's a special rule. If you get CPP benefits as a lump sum and it's for multiple years, you still have to put it on the tax return. You put it on the tax return in the year you received it. You do not separate it out, and you don't do adjustments for prior years. What you have to do in that case, which is a real pain, and I have done this, if you've done the calculation and you determine that had it been separated out over the previous years when it should have been received, that the difference in what would have been paid over all 3 years in tax was more than $300, in that case, you can ask the CRA to adjust it for you. You have to file a paper return with all the income on it this year. So you're not going to do the adjustment for them. You file with all the income this year, and you send a letter from Service Canada showing which year was how much money, and you ask the CRA in the letter to please adjust the prior years and charge less tax. And then you wait for them to make a decision, and they will decide a number, and that will be the tax that your person has to pay. And it's a paper return. You cannot e-file that return. So if that happens, then that's the process. Now, the reason why it's such a pain is because it usually doesn't apply. Most of the time, when someone gets a lump sum, even if they're up a tax bracket, once you factor it out over the previous 3 years, there's not that much difference in terms of what they're paying. So we do the math first, and we see, is there a difference? And almost every time when I've had a lump sum from CPP, there hasn't been a noticeable difference. It's still going to be a big tax bill for this year because they never take enough tax off CPP. So this year there will be a big tax bill, but it's going to be pretty much the same as it would have been if they had paid that tax over the last 3 years. So usually we don't have to do this. All I'm going to say for this from today is remember that there's a special rule for lump sum CPP, and if it hits, if you get this nice big amount and now they have a big tax bill and it's because of a CPP lump sum, go back to your textbook and look it up. And I will tell you, even though I teach this course, this is not something I keep in my head all the time. I know there's a thing about lump sum CPP. I know there's a process for how to do it. And if it lands on my desk, I pull out my textbook again and I refresh my memory. Okay. So generally speaking, you report CPP benefits. The person who receives it reports it, and they report it in the year they get it. And it is taxable. There might have been tax deducted off of it. There might not have been tax deducted off of it. And you can factor that in. Any questions? Okay. Employment insurance. So we've talked about social assistance. We've talked about workers' comp. We've talked about Canada Pension Plan income, not to be confused by Canada Pension Plan contributions. You're going to notice in this course that we're going to use the same words to mean different things. I really want you sorting out in your head, am I talking about money coming in or money going out? And keep them separate. Income goes on income lines, deductions go on deduction lines, credits go on credit lines. Keep them separate. Don't start mixing them up. We're talking about income today. So you can receive income through the Employment Insurance Benefits Program. If you do, it is reported on a T4 e-slip. The most common thing reported on this slip is regular employment insurance. So you had a job, you lost your job, and while you're looking for work, you need some income. You worked enough hours to qualify, you apply for it through Service Canada, and you get it. What are some of the other types of benefits that can be paid through the EI program? What is the most common other benefit paid through EI? It's not if you lost your job, but if you went back to school, there may be some tuition. So you can get some tuition assistance through EI. Maternity or paternity, parental leave is the other one. Some people qualify for parental leave through EI, in which case you're going to get a T4 e-slip. And there are some special rules for that too. So all of it comes on a slip that looks like this. You're going to have the tax here. You're going to have a repayment rate. Repayment rate is important. If it's 30% and your income goes over a certain amount, then you have to pay it back. You don't get to keep it. Some EI benefits do not have a repayment rate. So maternity, for example, does not have a repayment rate, and then the repayment rate will be 0. So if you're on parental leave, then you're not going to have to repay even if you're over the threshold. But if you are on regular EI and you have too much money from employment in the year, then you do have to repay it. Okay? It'll tell you how much was paid. That is the number that goes on the tax return, $10,500, whatever's in box 14 goes on the tax return. And then it'll tell you how much of that was regular. So sometimes the amount in box 15 does not match the amount in box 14. If that's true, we need to know why, because it needs to make sense. It might have been the very, very original COVID benefits. So if you remember way back at the beginning of 2020, there was the CERB, the CERB, half of which was processed through the CRA and half of which was processed through EI. The part processed through EI was not considered regular benefits, although it was taxable. So you would notice in that case that they would have a different number in box 15 to the number in box 14 if they were receiving CERB payments, CERB payments through that program. Okay, and again, some tuition might be non-taxable, some tuition might be taxable, so you'll have different numbers there. And then if they deduct tax, it'll be in box 22. How much tax is usually deducted off of EI? What rate do they deduct tax off at? 10%. Good. Is 10% ever enough? Basically never. Remember, the lowest tax bracket federally is 15% and provincially is 10.8. So unless all of your income is low enough that you don't owe any tax at all because of your personal credits, 10% is not going to do it. Most of the time, if we have a T4 e-slip, we are expecting that that taxpayer is probably going to owe. And right off the bat, as soon as I put EI income on the tax return, I start that conversation with my client. I go, have you collected EI before? Is this new for you? Do you know how it works? Do you know they don't take much tax off? It's taxable. A lot of people don't know that it's taxable. They think EI is tax-free. It's not. It's taxable. And 10% is usually not enough. All right, so you've seen the slip. There can be other boxes. If you see an other box, that's fine. You can take a look at what's in there. Most of it will be on these first sections. They are very common. Okay. What we're going to use the most is your box 14, 7, 22, and then box 30 is for any EI that you already repaid during the year. So sometimes you will collect EI, you'll apply for it, you'll get it, it'll be looked at, someone will look into it, and they'll go, actually, you don't qualify for all of that. We want you to pay some of it back. If you pay some of it back, they will give you the amount you paid back in a box 30. And that is a deduction on your tax return. Okay. That means you paid it back already during the year. Sometimes you have to pay it back on the tax return, so I don't want you mixing those two things up. We're going to talk about repayments that are calculated as part of the tax return. That's where you didn't pay it back, but you got too much money over the whole year. Then it becomes part of your tax return. If you paid it back in advance of the tax return, it's a deduction. Okay. Types of benefits, there's regular, there's employment benefits, there's taxable tuition assistance, there's non-taxable tuition assistance, which won't get added into your box 14 because it's not taxable. Okay. The other one that I want to mention, and I've got my notes here to make sure I don't get the box numbers wrong, you might have a box 36 and a 37. If you have a box 36 and 37, that would be maternity or parental benefits. You should also then have a letter from Service Canada that says how much of your EI was from maternity or parental benefits, and that needs to be reported on the tax return on a reporting number. So you're going to then have your EI income on the EI income line, which is line 11900, and then the parental portion, which you need that Service Canada letter to find, needs to be reported on line 11910. This is fairly new, so if you've been doing tax returns for a while, you might not know that you should have been doing this. Add it into your practice of what you do. If it's maternity leave, if your client says, oh, I have to keep an EI slip, that's great. What happened? Oh, I went on parental leave because, I had a baby. Wonderful. Do you have your letter from Service Canada? And if they don't have their letter from Service Canada, go get a letter from Service Canada and make sure you are reporting what you need to be reporting. Okay. And again, if they repaid during the year, you're going to get a box that says they repaid during the year, but sometimes they didn't repay during the year. Sometimes they got EI, but because the rest of their income was high, they weren't actually entitled to receive all of it. In that case, we have a social benefit repayment that is part of the tax return. So we calculate on the tax return what their income is before their social assistance. Then we look at how much their social assistance, their EI, how much they got before their EI. Then we look at how much EI was over the threshold for the year. Then we look at their repayment rate. If their repayment rate is 30%, they're going to have to pay back either 30% of all of their EI or 30% of how much of their EI was over the threshold, whichever is smaller. We calculate that number, and it goes in two places, and this is where people get confused. It's going to go into the repayment line, so it gets added to the tax you have to pay this year, which is in this case line 42200. But then, because you're repaying it, you also get a deduction for it. You're repaying it now as part of your tax return. So you're going to get a deduction on line 23500, so it will not get added into your net income for calculating benefits because they're making you pay it back now, but you have to pay it back now. So it gets added to the tax you have to pay this year. I'm going to show you what that looks like in two places. So the repayment calculation, we used to do this on worksheets. They keep moving where it is. Now you can find it on the second page of a T4E. And the tricky thing is that's a hard one to find. So even if I was looking for it in the on the CRA website, they kind of don't have the information there, and not everyone brings you a printed slip. So where I go to find it, if I want to do the calculation and I'm not doing it in my head, if I just want to see a place to do it on a form, I go to the reference guide. So Tax Academy Reference 2022. You can find in the information slips federal, a T4E slip here, and what you'll find is the repayment chart on that page. So if you need to do an EI repayment for an assignment or for a review problem or for the theory exam, and you want to know where the calculations are, they're here. What you're going to do is you're going to take the amount from box 15 minus any repayments you've already made. So minus anything from box 30, that goes on line 0. Then you're going to take the total amounts on lines 21300, 23400. That's basically UCCB, which you're probably not going to see, okay? And RDSP income, Registered Disability Savings Plan income, which I haven't taught you about yet. So for right now, that's not going to be relevant. So any deductions for those minus any income from those two sources. So if you have UCCB income or if you have RDSP income, you're going to sort of take out any payments you made against those two sources of income as well. That gives you line 1. You're going to take line 1 minus 70, 375, it's negative equals 0. Okay, take 0 or line 2, whichever's less. And then whatever's smaller, multiply by 3 times 30%, and that gives you the repayment. General rule, if it helps, use the chart. If it doesn't help, what I want you to do is take the EI income, see how much is over the threshold, and how much is the total. Whichever number is smaller is going to be your repayment amount. Where do you find the thresholds? Facts and figures have all the thresholds you could ever want, and your textbook tells you what the threshold is for the year. And the repayment chart tells you what the threshold is, so there's 3 places you can find it. What does it look like on the return? Well, I'm going to show you that as well. So let me jump back in here, and I'm going to pull out an actual return. I think this is a good one to actually see because now we're looking at multiple pages in a row, and it can get confusing. So again, follow it down one thing at a time. If you have EI income, you're going to have it on line 11900. There it is. The income goes on line 10900. When you get down to social benefits repayment, you're going to have a net income before adjustments figure. And then it's going to say, if you had anything on line 11900 and your net income is more than 73.75, go do your repayment chart and find out what you have to repay. Okay? If it's social, if it's EI, you're going to do it there. We will be learning about the same thing. We call this a clawback. So you may hear clients use the word clawback. You're definitely going to hear tax associates call it the EI clawback. In that case, it goes here. If it's old age security, there can be an old age security clawback as well. It's calculated in the same place, just in a different thresholds, different amounts. Okay, but all of your clawbacks happen in this part of your tax return. So EI, look to see is the net income before adjustments more than 73.75. If it is, and you had EI income, make sure you're calculating the EI clawback. You calculate the amount, you put that number on 23500 because you're not going to be dinged for it because you're actually having to pay it back. And then you actually have to pay it back, and that's the part where you go down to step 6, and you're going to see social benefits repayment line 42200, and it goes in there. So it's going to add to how much tax you have to pay for this year. Okay, why do people have clawbacks? So we have some clients where they have really good incomes. So they might work, let's say, on an oil rig, and they will go over to Alberta, and they will work for 6 months and make a lot of money, and then it's kind of temporary work, and everything will shut down, and they will get laid off, and they will apply for EI, and they'll come back to Manitoba, and they'll collect EI for a couple of months. And if you made a lot of money at the beginning of the year, you're going to get that EI, but what happens when you file your taxes? So you got your income, really high income, really good income. Then you got a whole bunch of EI, which you were eligible to claim because you had been laid off. What happens When you file your taxes, you're going to have to pay it back. And we see this a lot with some of our younger employees. They know they're going to have to pay it back. They know that tax bill is not going to be great, but they wanted the money anyway, so off they went. I do encourage people, if you know you're going to have to pay it back, maybe don't collect it, but nobody does that. They collect it now and they worry about repaying it later. And that's fine, but remember, EI, you're usually going to owe tax. EI plus a clawback, you can owe a lot of tax, depending on how big the clawback is. Okay? Any questions about employment insurance, income, and clawbacks? We've done a whole bunch. We have a whole bunch more to do, but we've done a whole bunch. We have done workers' comp, social assistance, CPP income coming on the return, and we've done employment insurance income. Brittany, why do they give it if they know you have to pay it back? Well, you might not get another job. So you might be on EI next year, and then you are entitled to it. So, yep. If they know up front, they will ask for money back up front. But generally speaking, Services Canada is busy, and they are confident that when you do your taxes, they'll get it back anyway. And if the people take it because they have not saved any of the money that they earned while they were out on their low rig. They went and they enjoyed it and they spent it and it's gone. And now they have 5 more months and they need to pay rent. So they go on EI, they collect rent, and then next year you give them a big tax bill, but then they have a big income again, so now they can pay their big tax bill, and then whatever they get, they spend. So we see that as people get sort of into higher paying jobs, they may not choose to apply for EI if they know that they're going to have to pay it all back. And then there are definitely a lot of people who collect EI who never have to pay it back because they really needed EI. And again, we saw a lot of people going on EI as a result of the pandemic and the shutdown and people losing their jobs. So we're definitely seeing a lot more people using that service in the last couple of years. And rightfully so, that's what it's there for. Okay, so EI insurance repayment applies only when the rate is 30%, and it only applies to the amounts in box 15. So if you had maternity or paternity leave, it would not apply to that. Threshold is $73.75 for 2021, and it is the smaller amount of either everything you got in box 15 or your net income before adjustments over $73.75. All right, I want to talk about COVID stuff next. I'm going to go fairly quickly through some of this because some of it is getting old enough now that you're probably not going to be seeing as much of it as we did. If it was the year before, I'd be spending more time on the CERB slide than I am now because CERB doesn't really exist. You can still retroactively apply for it. It is possible to go back and apply for it. I'm not sure if that's going to be true by the time we hit next tax season. I think there will be a cutoff for that. But we are seeing lots more complicated types of income that we had to adapt to very quickly as taxpayers. So we started seeing new box numbers, new tax slips. If you worked in tax in the year when all of this happened, we didn't know what it was going to look like until it showed up on our desk. And some of it, we had people coming in February and they still hadn't received any slips and we couldn't tell them what slips they were waiting for because they were still figuring it out. Now we know. Now they have a system and we can all agree to what the system was. You're going to notice it looks really complicated in the book. So what I am going to say is make sure you're aware of it. Make sure you know how to look it up if you need to look it up, and use the charts and tables in the book. They're very good to help you know what type of slip you're getting and where you're going to report the income. Okay? So CERB was the first benefit that we saw, the Canada Emergency Response Benefit. It was $500 per week. It was taxable. It had no tax deducted from it. So if you got it, you got all of it. They didn't keep any tax back. And you can apply for it 2 ways. If you applied through the CRA, you got a T4A slip with a box 197, and then you take all of that money and you put it on line 13000, which is your other income line. Not to be confused with your other employment income line, it's your other income line. Okay? Or if you applied through Service Canada, you would get a box 14, and it would just be included in your box 14, and it wouldn't say on anywhere on it that it was CERB. But you would notice in that case that your box 15 and your box 14 didn't match, and you would be able to see and represent a client that they had applied, and in that case we would know that a portion of it was CERB, and there was an adjusting number we would have to put on the return to let them know that some of it was CERB. In that case, it would be on line 11900 because it was paid through EI. Still taxable, and no tax was ever withheld off any of it. In order to get it, you had to have $5,000 net earned income. So that's income from employment, income on line 10100 or 10400, or self-employment. And it got really messy with the self-employment people because they did not do it right. Okay. And then there was limits on how much you could earn while you were receiving CERB. So if you started earning money, you wouldn't get it anymore. Okay. It gets really messy if you had someone who was not supposed to claim it, but they got it anyway. There are definitely people who applied for it and they ticked the little box in the application that said, I had $5,000 of earned income, and they didn't. And they got CERB, and they have to pay tax on it. What would happen to someone who was on social assistance who got, let's say, $18,000 of CERB income in that year? They'd have their social assistance, which is not taxable, and then they'd have their CERB income, which is taxable. They have to repay it, but not on the tax return. They would owe money on the tax return because it's taxable money and had no tax deducted. What would happen for next year? When they applied for social assistance next year, what would their net income be? Too high to get social assistance, too high to get rent assist, too high to get medical assistance, pharmacare. So this is a problem, and this is a problem we are still dealing with. And of course, we had all of the people who received COVID benefits and then had never owed before and did not want to file tax returns because they don't want to owe money. What happens if you owe money and you don't file a tax return? Penalties and interest on top of it. What happens if you want to get social benefits and you don't file a tax return? Do you get your social benefits? Nope. So all of those people who came in and then didn't file because they were going to owe, then they got cut off from their social benefits. They've been coming in the last year to file now to get everything sorted out. If you are doing taxes in the next couple of years, you are going to be dealing with clients who have done things to their tax returns that we have to help them fix. And sometimes we can't help them a whole lot except to get them up to date with the CRA and get them into a payment plan. Now, you will find if they are repaying, we have some special rules for what we can do with COVID-related repayments if they're federal, and we'll talk about that. Okay, so if they're repaying, they're going to get deductions for what they repay, but remember, you generally report income the year you receive it, and you report repayments in the year you make them. So we'll talk about that. But definitely we found with COVID, it was a very good program that helped a lot of people. And then there were a whole bunch more people who either because they didn't know what they were doing, or if they knew what they were doing and they did it anyway and they thought they'd get away with it, have now created some scenarios. And because they are related to tax returns, we are now responding to those. Okay? There's one more thing I will say. If you're in Manitoba, you have to be careful. COVID and First Nations income can get really messy. So I'm not going to cover it in this course. All I'm going to say is if you decide to work in Manitoba in tax, and you're pretty much dealing anywhere that has people with First Nations income, and there are issues with COVID payments, you really need to find a specialist who can help with that because it gets very complicated. Yeah, and Brittany, you were happy you didn't have to receive it. I would have been eligible for some, but in my case, I was aware that the complications of what I would need was going to be more than what I could do kind of finding other sources of income for me. So I did not receive it, but I definitely know people who did receive it and needed it, and it was very beneficial, and they would not have been able to pay their bills if they hadn't have had it. It was a good program. It was a fast program. because it was fast and it had to be fast, it has been complicated. All right, so we had CERB at the beginning, then it was replaced with the new Canada Recovery Benefit. And for that one, if you were on EI, you got EI. If you didn't qualify for EI, most of the people who didn't qualify for EI but get the Canada Recovery Benefit are self-employed. So those people will not be ones that you're doing tax returns for necessarily. But there were some people who were employed, but they didn't work enough hours to qualify for EI, but they did work enough hours to qualify for the Canada Recovery Benefit. They got switched over to CRB. CRB was a maximum of 27 two-week periods between September 27, 2020 and October 23, 2021. And again, you can still apply for some of these retroactively, so even if they didn't get it when they needed it, they might be getting it now, so we might be dealing with it next year. Okay. It's reported on a T4A box 202. You put it on line 1300, and in this case, they deducted 10%. So the good news is some tax was deducted. Would you say enough tax was deducted? Probably not. 10% was probably not, unless the only source of income they had was CRB. 10% was not enough. The tricky thing for CRB is there is a CRB clawback if their net income, not including CRB, was more than $38,000. So if they applied for CRB and they got it, but their net income was more than $38,000, they will be asked to pay it back. And how much they'll be asked to pay it back is 50% of every dollar over that $38,000. And then if they weren't eligible at all in the first place, an additional 50% penalty. Okay. We don't have to calculate that. That's done through the CRA. They would get a letter saying you weren't eligible, you have to pay it back now, these are the consequences, this is how much. So that's not done on the tax return, but it does mean in the next year or two or three, I think we're going to start seeing more COVID repayments on tax slips, and we are going to have to deal with the repayments when they do pay it back. Okay. Now, there are definitely people who filed and they thought they were eligible and they weren't, and it was confusing, and the CRA has been very forgiving for those people. There are definitely other people the CRA is not going to be forgiving about. So it's going to be a case-by-case basis, and we can't predict it. But if we have a client who received CRB and they're really stressed about it, we know enough about the situation to be able to give them some advice. So what you need to know, CRB, you're going to see a box 202 on a T4A. Put the money on line 1300. Keep an eye out for any repayment boxes. If there's a repayment, we'll have options to deal with that repayment. Other programs, there was a Canada Emergency Student Benefit, which was a flat rate. It's reported in box 198 of a T4A. If you see it, put it on that line. If they got a top up, it's on box 199. Add it to line 13,000. No tax was taken off any of that, so there won't be a tax deducted line. There is the Canada Recovering Caregiving Benefit that is ongoing, so we're going to continue to see that. If they receive it, you get a box 204, and 10% tax will be withheld, so put the tax withheld on. There's a Canada Recovery Sickness Benefit. If you qualify for it, you'll get a box 203, put it on the other income line, and put the tax that was deducted on. So these ones, the benefits exist. They've already happened, so you have to deal with whatever happened. Get a tax slip, put it on the return. Okay, there's a Canada Worker Lockdown Benefit, box 211, and tax will be withheld. And then there are provincial ones. If you want more information about what provincial benefits were available or might still be available, the provincial supplement will help you with that. But again, you're going to get a tax slip with a box number. Get a tax slip, get a box number, put it on the line. Okay, so anything provincial will be in box 200. Put it on the other income line. And Brittany, if someone was sick but their work paid sick days and they still applied for the sick benefit, they'll have to pay it back, yes, because they wouldn't have been eligible, so they'll have to pay it back. But if their employer didn't pay sick days, or their sick days weren't enough to cover how much they were off, then yes. And there were complications with this benefit too, because the government said that in order to get it, there had to be a mandate that said you had to stay home, but there weren't any provinces that had that mandate, which meant no one in the country was eligible for it. So they changed the rules again. Mostly what I'll say is if you have a client asking you questions about COVID benefit, the CRA has some very good resources that tell you what's available and how you get it, and you can direct them there. We don't help our clients apply for COVID benefits. That's not something that we do. All we do is deal with what happens after they've already done it. But I will say if a client comes to me and they're like, you know what, everyone at my work is getting sick and we don't have a sick policy at work and I'm going to be off and I don't know what I'm going to do to pay the bills because I'm not going to get paid, and you know that there's a benefit for that, you can tell them, hey, let's look at this together. So Brittany, at the time, so there was originally mandates you stay home and quarantine officers were making sure you were there. By the time they put the new ones in, there were no more quarantine mandates. So there was recommendations, but no mandates. Oh, Brittany, your comments are not going to everyone. I think they are going to everyone. Oh, because you have all panelists, make sure you say all participants. There we go. Yep. And then everyone can see it. But I'll try to read the questions out as I go as well. I'll get a little bit better about that today. Okay, so COVID benefits exist. We are dealing with them. The interesting one, and the one that I want you to know about, is what can we do with repayments? So remember, if you received the income, you had to report the income on that year. If the repayment happened in a different year, that deduction is going to happen in a different year most of the time, which is not helpful if what we're trying to fix is the fact that their net income was too high to get social benefits and things like that. So we now have a choice, and this is very rare, so it's very new. If it's federal COVID benefits that you are repaying and the income was on a previous return, you can choose if you want to claim the repayment on this year or on the previous year, or if you want to split it between the 2 years. You have a choice. Okay. Now, you've already done the previous year's return, probably, in which case you're going to do an adjustment for that return and put the remainder on this year. Or you can put it all this year, or if it's not going to help you this year, but it would have helped you that year, you can choose to claim it all on the previous year. So you have a choice for repayments that were made in 2021 to pick which tax year you're going to apply them to. Only the federal benefits, though. If it's provincial and you repay it, the deduction is the year you repay it. Okay. Any questions about that? We'll talk about adjustments at the end of the theory chapter, how to do them. But generally speaking, you're going to get the repayment, you're going to look at it, you're going to go, oh, I can use it this year. If you don't need it this year, you're going to look at previous year and you're going to say, did they have a lot of income? Would it be better to claim it there and know that you have that option? Okay. And again, I don't necessarily say memorize the COVID stuff. I say remember that COVID stuff is tricky, and if you get it, know how to look it up. It's all in Chapter 6, and a little tiny bit of it is in the COVID section on the provincial supplement. Okay. I think we probably need a break. I was going to do it after donations, but I'm going to do it now. Okay, so let's take a break. It's 10:03. I'm going to give you a slightly longer break. I don't think I'm going to get the review problems done today necessarily, but I can get through all the theory. So let's take a break until, I'm going to say, 11:10. Let me know how you're doing. All right, let's see if everyone is back together. Brittany asked a very good question. I'm going to answer it generally because I think that that is ideal. So I'm not going to deal with the anything that isn't broad strokes. But yes, I know for a lot of people, if you work through the week, then trying to do homework Monday night, Tuesday night may not work for you. I will always on the whiteboard have the next 2 classes in advance what I want you to do, because I know it was the same for me. When I took this course, I took it where I had a certain number of nights a week, and I was also working 3 jobs and doing a master's degree. So it was kind of like I had to know my calendar well in advance of what was going to have to get done. but you have a class schedule, so everyone should have it. If you don't have a class schedule, send me an email and I'll send you another copy of it. It tells you what we're going to do each week broadly, and the homework for each week is always going to be all the exercises and the review problems. That's just what it's going to be. And it'll give you the deadlines for assignments as well. But again, because I know for most people, I'm always going to say for next class, do this. For the class after, this is what we're doing next. So if you can't do it weeknights and you have more time on the weekends, you can work ahead. And working ahead is great. And if you have questions when you work ahead, ask me. I will answer them. Ask me by email. I'll answer so that you don't get stuck and you can keep moving forward. If you want to do your review problems in advance, send me your answers and I'll look at them for you in advance so that you can keep up, because I know this is a very homework intense course. To that end, I know some of you are already worrying about the assignment, so I'm going to mention it very, very briefly. For assignment 1, it will be marked. It will be done on ULearn, but you must do the case in Inkling first. You have to have the case done in fillable forms before you run it in ULearn. Please do not run it in ULearn until after Wednesday's class, because on Wednesday's class, I'm going to give you a lot more information about how to do it. I'm not going to do it today because we have time. It's not going to be due in ULearn until the day before your next class, which will be, it's due midnight of October 11th, okay? October 12th, it must be submitted, and I cannot do extensions because on October 12th, I'm going to take up the answers. Everybody will have the answer. It's only 10%. Don't open it until you're ready because you get one attempt. Once it's open, you have a 3-hour time limit, and at the end of that 3 hours, whatever you've entered is what your mark is going to be, and I can't change it. What you can do now, if you want to, because you are already going to be reading Chapter 7, you're going to notice that Assignment 1 is Review Problem 7-1. You can start working on the fillable forms. I'll talk about more detail. Don't open it in advance. Please don't open it in advance. I cannot reopen it for you. But if you want to work ahead, start on those fillable forms. Start working on it now. You have time, okay? For next class, you do have to do Chapter Review Problem 7-2. That one I do want you to have done, because we are going to take that one up together so that you have all the information you need before you actually have to do your assignment. And I'll make sure we get through everything so you have time. And then you can use your Thanksgiving to do tax courses. It always works out at Thanksgiving for my classes, so that will be fun for everyone. Okay, so work ahead. If you need to work ahead, it's perfectly fine. I will always give you 2 weeks in advance on the whiteboard so you know what you're working on. And if you ever have questions and you say, look, I'm not going to get it done, I need to work ahead, what are we doing on these days? Send me an email and I'll tell you. Okay, let's finish off this chapter because we can get it done now. I'm going to share my screen again, and I'm going to see how much we get through, if we even get to the review problems. We might not. I only say we might not because Canada Workers Benefit just got more complicated this year. Of course it did. All right. So first thing I want to talk about, charitable donations. Most people have a sense that if you donate to charity, you can claim it on your tax return. Broadly, that is true, but there are limits to what you can claim and how much you can claim. So we're going to talk about that today. So first, to claim charitable donations, you have to have receipts. They have to be official receipts, and it has to be a registered charity. We're going to talk about that. If you have it and it's eligible, you get 15% of the first $200, and then everything else up to your limit, you get 29% unless you're in the top tax bracket. If you're in the top tax bracket, you get 33%. Why are they rewarding wealthy people more than not wealthy people? What behavior are they trying to encourage wealthy people to do? Everybody else gets 29% over the $200. Everybody, except if they're the top tax bracket, they get more. They want them to give more. They want to encourage wealthy people to donate to good charities. So that's how that works. Okay. If you get a federal credit, you usually also get a provincial credit. You have to look each province up. Manitoba, you do get a credit And if you have questions about what you get, you can read the provincial supplement for that. It is usually basically a matching credit, except instead of 15%, it'd be 10.8 and then more. So you'll have a provincial calculation as well. The donations have to be gifts. It has to be a thing that you give and you don't get anything back. So there are lots of things where people consider it purchases for charity, but it doesn't count. So can anyone think of an example where you might be going to a charitable function that would not qualify as a donation? We'll see how many rollers and shakers we have. Bingo tickets. If you're going to bingo charity, you're paying to a charity, but they're giving you a bingo game, so that doesn't count. Hospital lottery does not count because you are purchasing the opportunity to buy a house or to be given a house. So even if you don't win the house, your hospital lottery will not be charity. Auctions, there are lots of charities where you go and you get a nice banquet and they feed you and they entertain you, and then there's a silent auction, and then there's all kinds of things. Those would not be charitable donations. However, at those events, there may be a portion of it that counts as the credit, in which case, believe me, that organization will give you a receipt and it will give you a breakdown and tell you this portion you didn't get anything back for, so for this portion it is charitable, and the rest of it, the food, the entertainment, the auction, all of that stuff will not be considered a charitable donation. So a lot of times you'll purchase tickets to a gala and the ticket will be $250, and you might get a charitable receipt for $50, and the $200 will count as your dinner and entertainment. So whatever's on the receipt has to be broken down and it has to be clear. Okay. We're going to talk about what receipts qualify, but for now, just broad strokes, if it's on the receipt, make sure you have a receipt. You get 15% of the first 200, and then generally speaking, 29% of the rest, unless you're in the top tax bracket. You can claim donations for yourself or donations made by your spouse. Why might it be beneficial to lump them together? So let's say I donated $300 and my spouse donated $300. Why would it be better for one person to claim all of the donation rather than for each person to claim their own? Might be who has the bigger income. Might just be because if I claim 300, I'm going to get 15% on the first 200 and 29% on the rest. If my spouse claims 300, they're going to get 15% on the first 200 and 29% on the rest. If we put them together, it'll be 15% on the first 200, and then on the 400 extra will be 29%. You get a bigger credit. So pooling them together is often better than separating them, but it is up to your clients to tell you what they want to do. I definitely had one client where they were a married couple who liked to keep their finances separate, and even though it would be more beneficial for one person to claim all of them, they insisted on separating out and claiming their own donations, even though they were going to get less money back from the government if they did that. That's just how they run their finances, and that's their personal choice. So you have the choice to pool. Usually we recommend to pool if you can, but you don't have to. And you can split it. So you might have donations, and you might have a lot of donations, in which case, if one person doesn't need all of it, you can use just enough to wipe them down to zero and split the rest with the other spouse. Okay. In order to claim it, you need a Schedule 9. You need to complete a Schedule 9. Schedule 9 used to be a very easy return or schedule. It used to be one page. Now it's more complicated because they've added some more things. So we will make sure we can all do a Schedule 9 after today. Okay. Donations are limited to 75% of your net income. You cannot donate and get a credit on your tax return for more than 75% of your net income. You can donate more. You just are limited to how much you can use. And this does happen. I know I get asked every year, who would do that? Well, there are lots of seniors who have very nice incomes and no one to leave their money to. And they may have, a reasonable amount of income in the year that they don't really need all of because everything is basically paid for in other ways. And they will donate large quantities of money and assets and stocks and make donations to churches and events that they care about and donate to some kind of building that's going to, put their name on the side of the building, and they can't use it because it's more than their income. And that does happen, and we have to make sure that we're limiting it to 75% of their income. Okay. There's special rules for gifts of certified cultural property, ecologically sensitive land, and donations made in the year of death or immediate preceding year. I'm going to say that that is outside of the scope of this course, except to know that it exists. So certified cultural property and sensitive land, they have special rules. If you see that, you're going to need to look up those special rules. Something that happens in the year of death, you need a specialist because the year of death has a lot of rules connected to it, and you really should not be doing that return if you don't know what those rules are. We have a whole course on that. And then there's a rule that says members of religious orders who've taken a vow of perpetual poverty, they can donate 100% of their income and pension benefits to their religious order. In that case, you're not going to do a Schedule 9. In that case, you're going to do a deduction of all of their income on line 25600. They have to donate all of it. They cannot choose to donate most of it. It's all or nothing. And you'll have a letter from the place. Vow of perpetual property examples, you might have a nun. So you have a taxpayer who's a nun or a monk. I had one. So in all the years I've done this, I've had one. Okay, and we had a question, Helene, can they carry forward? Yes. So if you can't use it this year, you can carry donations forward and claim them in future years. Or if you choose not to use it this year, you can pool it together with multiple years. Does anyone know how many years we can do? Someone who's read the book? 5. So if I have someone who always donates $100, I might not claim it this year. Even if they could use it, I might not claim it this year because if I know for a fact they're going to do it every single year for 5 years, they will get more if we save it for 5 years and claim it all at once. Now that requires your client to be organized enough to keep their receipts for 5 years and remember that they didn't use them. And if you have a very disorganized client, I would say go ahead and put the charitable donations on right now because they're never going to see them again and they're never going to remember what they did. But if you have a very organized client, then you can do that. And Leon, do the charities need to be located in Canada without exception? Not without exception, but we're going to talk about that. So we're going to start with how much you can deduct and carry forwards. Let's talk about carry forwards. You can claim for yourself or your spouse anything you did now or the next 5 years. So 5 years basically in a pool altogether. It's useful if you don't need it. So if you have a client who made donations, but they don't need any credits, because remember, it is a non-refundable credit, save it. They'll claim it next year. I do this in real life by putting a sticky note on the receipt. I make a note in my file that says they have a carry forward for that there's a donation that we didn't use and how much it is and what it was for. And then I give them their receipt back and I say, put in your tax file for next year and bring it back to me next year. And I put a sticky note on the outside. I staple it to it that says, did not use in 2021 or in whatever year, and then hope they bring it back to me. And then if they're my client again, I see, because they're my client again, I get that donation note in my file saying, oh, there's a donation that they didn't use. And then I go, oh, hi, good to see you again. How was your year? Did you bring that receipt back, the one we talked about? Do you still have it? Can I see it? If you still have it, I can put it on the return now. Okay. Donations are not tracked on the tax return, so you have to keep the receipts, and if the CRA asks to see them 5 years from now, then you have to see them 5 years from now. It gets messy if you have these really big donations where you claim half now and half later. You're going to have to keep track not only of the receipt itself, but also how much of it you've used in a previous year and how much you have left. And there are no forms for that. We just keep track. And Cool Winter says, is GoFundMe donation claimable? Generally not. Most of the time, GoFundMe does not qualify as a registered charity. So I haven't seen one that qualifies because it's not a registered charity. And also, GoFundMe often is used for things that don't count as what charitable receipts are used for. So we'll talk about that when we get to what's allowable. Okay. So let's talk about who we can give donations to. So this is the broad list: registered charities, registered in Canada charities. Registered Canadian Amateur Athletic Associations, they exist. I have not yet seen someone donate to one, but I am told that they exist. In Manitoba, they're probably hockey-based. Registered National Arts Service Organizations, again, they exist, but it's rare that they would be that and not also registered charity, so usually we're just going to get a registered charity receipt. Registered housing corporations that are resident in Canada and set up to provide low-cost housing for seniors. Municipalities. Municipalities are interesting because you can make political donations to the federal government and to the provincial government, but you cannot make political donations to a mayoral race. That is not a thing you get a credit for. However, you can donate to your city if your city is a registered municipality, and you'll get a receipt in that case. And then anything that Canada, if you want to give money to Canada, a province, or a territory, you can do that and you'll get a receipt for it. Okay, general broad strokes gifts. Where do we get this list from? How can you find out if something is a registered charity? You have to look it up on the CRA. And I'm going to stress that this is very important. Okay, some charities you're not going to have to look up because you know that they are currently registered and in good standing, because they have lots of rules that they have to meet in order to qualify for this, to have tax-free income, in order to qualify to issue donation receipts. So some of the ones you're going to see all the time: Red Cross, Alzheimer's Society of Canada, Heart and Stroke Foundation, Diabetes Association. Some of those you're going to recognize because we all see them. We know that they're working in the communities. Other ones, no. So a lot of times someone will bring you a receipt for a church and it has a church name on it. It might even have an official registration receipt. But if you don't know that the name of that charity, you really should look it up. How you look it up, you're just going to go to the CRA, say list of charities. It's going to take you here and you can do a search. So if I'm looking for, let's say, Red Cross, I type in Red Cross. I'm looking for anything that's registered, and I say search, and it's going to bring up anything that has words similar to Red Cross. It's going to tell me if it's currently registered and how long it's been registered for, and I can see that the Canadian Red Cross Society is a valid registered charity. It's in good standing, and it has been since 1979. I will tell you, I had a client who brought in a receipt from a church. It was a local church. I didn't know of the church. They had a registered charity number on it. I put the church name in, and it did not come up as a registered charity. I put the registered number in, and it came up as a different organization that was definitely not the church. This person had donated about $12,000 to the church. It was not a registered charity, and we could not claim it on the return. Charities get audited all the time. So charitable receipts often get requests for info. You often have to send the receipts. If you send the receipt and you've given someone a $12,000 non-refundable credit and it's not a real charity, that's an expensive mistake for your client. So I had to tell the client, unfortunately, that church is not currently registered. I can't use this. You're still welcome to donate to them if you want to donate to them, but understand you're not going to get a tax credit until they are an official registered charity. If you have concerns, you should speak to the church about it. And that's where we are. So if you don't know, look them up. Okay? For the purposes of this course, if we say local church in a case, assume that it's allowed. Most churches are registered charities. It's just that not all of them are. Okay? And yes, what we're talking about on this list are all things that have to be in Canada. Okay? I'm going to go back here. We're going to talk about some of the other ones that are not in Canada next, but that's where we're going to start from. Does anyone have any questions about how to access this list, how to use it? You have to have the receipt. If you don't have the receipt, don't put it on because they will get audited. And if they don't have the receipt, even if they did pay for it, they're not going to get their money from the government without giving them a receipt. So make sure you see the receipt, check the dates on the receipt. Your clients are going to bring you all kinds of things from previous years, and they'll bring you ones for next year, and so check the dates. And then, Karina, where to look up for local churches? Good question. You're going to go to the CRA website, and you're going to type in list of charities. And the first tab that it gets is this page, list of charities and donees. Click on charities. It takes you to a search function. You can search by the charity name or you can do an advanced search if you want to. If you have a business number, if you have any other information about the charity, you can sort of specify, but generally the name is enough. So if I'm looking for a specific name, I might say St. Luke's. I'll just say Luke and see what I get. And if I look, I can find all of the places that are St. Luke and the parishes and where they're registered, and I'm going to find the one I'm looking for on my list. And if it's on the list, I can claim it, and it will tell me the dates. And you'll find some of them, they were registered and they're no longer registered, and you'll be able to see if they had charitable status and they've lost it when they lost it. And that'll tell you which years you can claim it in. Okay, but do make sure you're looking it up. All right. So there are some exceptions to things having to be in Canada. So if you want to donate to something outside of Canada, first of all, go ahead, make donations. Donations are good. Support the organizations you care about. That being said, you might not get a tax credit for it. If you want to get a tax credit for it and you want it to be outside Canada, you can donate to United Nations and its agencies. United Nations doesn't have very many agencies that are eligible, but if they do, you can find it there on the CRA page. It will tell you which agencies are allowed. Registered universities, which ordinarily include students from Canada in the student body. If you want a list of those universities, go to the CRA list page and it is there. And then registered foreign charities to which the Government of Canada has made a gift. If the government decided it's something we're going to support, then they will let you claim a tax receipt for that as well. And again, I'm going to go back to my list. Now, Brittany asks the question, how would a local church be able to produce a receipt with someone else's code? Well, they have to get their hands on a charity number from anywhere. Maybe they were registered and they lost their registration, in which case they'll have a number, but it's not valid anymore. Or maybe it's fraud, and they just found a receipt, looked up somebody else's code, and then called it their own, which is probably what happened in this case. All right, so if I go back to my charities and giving, and I go to my list of charities, and I want to see which universities outside Canada, which university outside Canada can I donate to? Well, there's a list here, and they're sorted by American, UK, and then other. If it's not on the list, then you can't claim it unless, and we'll talk about the unless in a minute, but generally speaking, it has to be on this list account. And you'll notice the American ones are in order of state, alphabetical order by state, UK, alphabetical order starting with England and working our way through Ireland and Scotland, and then other countries, alphabetical by country. Okay, and if you're curious for who has received a gift from Canada in recent years, you can see that we had a gift to the Aga Khan Foundation in Switzerland up until 2022. So for 2020 to 2022, if we have a receipt to that, you can claim it. United States Council for Canadian-American Relations, 2021 to 2023, we can use those receipts. If you want to go further back, occasionally we have made donations to Auschwitz-Birkenau Foundation, so it has to fall within those years and those dates, but if it does, you can claim it. All of that information is here. Again, most of the time, we don't have to do this. If it's really clear that it is a current valid registered charity in Canada, go ahead. When we get outside of that and we start doing things out of the country, or we start doing universities out of the country, you should be looking at these. And again, if it's an organization you've never heard of before, it takes 3 seconds to look it up. Okay, so we've talked about what you can do if it's out of the country. Except for US, we have special rules for US because they're very close to us. Gifts to US. If it's an American college or university and you or a member of your family is or was enrolled, then you can claim it as a donation even if it's not on the list. But you might have to prove that somebody was enrolled in it if they ask for it. And then other organizations, if it's recognized as a US charity, you can claim a deduction on your tax return, but only against American income that you're reporting on your tax return. So if you have American income, remember in Canada we report world income. If you have an American source of income and an American donation that the IRS would allow, you can claim it, but only against 75% of your American income. Those of you who are working, especially in southern Manitoba, this may become more relevant because we do have people who live on one side of the border and work on the other side of the border. So they will have more American income, but they're filing a Canadian tax return, and they may have donations that go through their employer to IRS ones. And so that becomes important. And then commuters, so those people who are in that exact scenario where they're living right on the border and they live here but work there, in that case, if their main source of income is American income, then they can claim up to 75% of their world income for American charities. And again, in that case, we have to find out if the charity is recognized in the U.S. rather than if it's recognized here. Most of the time for this course, that's going to be an unusual circumstance. So again, I would say be aware that it exists and don't worry about it until you actually see one. Okay. Any questions about what we can claim, when it's allowed, when it's not allowed, how much we can claim, all of those things? I want to make sure we get a chance to look at a Schedule 9. So we're going to do that very, very quickly. Okay, how do I find a Schedule 9? I'm going to go from the CRA website, and I'm going to look on the federal side, and I want to find the donations and gifts schedule. I'm going to open it here. You can do the fillable forms. You're going to put all of your Canadian things on line 1, anything to a Canadian government body on line 2, to a registered university outside Canada on line 3, and then any of the foreign registered ones on line 4. Add them all together. Then they want your net income, not taxable income. Net income times 75% will give you the max that you can claim. And then this section in here, capital property, we're not going to talk about. That's outside the scope of this course. That's complicated. Believe me, you need several courses before you can handle that. So if you do have someone who donated something that isn't money, go find a senior associate to help you. Because if you do that one wrong, it can be really messy. I had to fix that for a client, and it took about 2.5 years between all of the audits and the adjustments in the previous years and getting the receipts, and it was a big thing. So make sure if you have capital property that's donated, go find someone who knows the rules for how to deal with that, because it gets fun. For us, cash is very common. We see people make cash donations all the time. If it's cash, go ahead, you can do it. Okay, then we're going to take whatever's smaller, 75% of net income or the total donations, and that's going to tell us what we can claim for this year. We don't have to use it all this year if you don't want to, and remember, you can split it with a spouse. If you want to split it with a spouse, you have a choice. So you're going to say what you're actually claiming, and then at the bottom, we're going to calculate what you can claim. So again, if you look at previous years, there are different numbers of forms. For 2021, we have 1 page. For, I believe it was 2019, we had a 3-page donation form. So if you're doing older years, you might find it looks more complicated. Essentially, what we want to know is how much income do you have in the top tax bracket. If you do, you're going to be getting 33%. Otherwise, you're getting 29%. The first $200, you get 15%. You're going to calculate your donation there. Okay. Practice the forms. You're going to get to do it in your review problems. Be careful. There's one place other than a receipt where you might see an allowable amount to put on this form. Very good. Thank you, Marisa. T4. You can have donations that are paid through your employer. If your employer pays donations for you, you will have a box 46 on a T4. If you have a box 46 on a T4, you do not need an additional receipt. You don't need anything else. The employer is responsible for all of that. Just add it on the form. And Brittany, you found it on 6-1. Good. And Leon, out of interest, can someone donate to their own charity? Yes, technically, if their charity is incorporated or they have a registered charity, there are some special rules for that. That's going to be beyond the scope of this course, because in order for it to qualify as a registered charity and for them to be putting money in and against it, there's a lot of paperwork and audit-related rules they have to do to make sure that they're not paying themselves out of their charity and avoiding tax that way. But yes, it is possible if you set up a charity that you can also donate to your own charity. Again, it has to be a registered charity, and the charity has to issue a valid receipt. Okay, so Make sure you can do a Schedule 9. Practice them. We do these all the time. These are very, very common. Lots of people, especially seniors, will donate to everyone who phones them and knocks on their door, and they get a receipt for $20 and a receipt for $30 and another receipt for $10, and we add them all together and off we go. And then you'll also definitely find that there are some families who are members of religious organizations where they have some form of tithing, where they give regular amounts of money to a religious organization. We see that all the time. And of course, we have people who have family members with health issues or other concerns who may be donating to homeless programs or to food banks or to other services like that, or medical research. So we do see donations all the time. Canadians are actually pretty good. I find of the taxpayers that I see, a lot of people do donate. All right, couple more things, and then we're going to be done. I think we can finish the theory, and we'll do the review problems next class. So legal expenses. Broad strokes rules, legal expenses are most of the time not deductible on a return. Lots of people will say, I had legal expenses, they'll bring you the receipts, they want to put it on the return. Anytime you get them, I want you to go to your textbook and I want you to look up the rules for legal expenses, because I will tell you, I still use my level 1 textbook when someone brings legal fees to me, with one exception that I know for a fact because I deal with it a lot. Everyone else, I want to go to the list. If it's not on the list, they cannot claim it. So that's rule number 1. Lots of people have legal fees. Lots of people cannot claim their legal fees on a tax return. You could only do it if you had the legal fees incurred in order to make money from business or property, or in order to get child support, or to get more child support, or to collect child support. Those are the broad reasons why you can. Everything else is no. I do think the textbook is very, very good in this section. So I'm going to go to the textbook and show you which page I keep by my desk for the times when people bring me legal expenses. Okay, so like I said, I promised I would tell you which pages I think are the extra good pages, not necessarily because you need them for tests and exams, but because you need them for life. There are things that you're going to want to have at your fingertips to look up. So for me, Chapter 6, legal expenses, deductible and not deductible. What's allowed and where does it go? Because depending on what it is, it will go on a different line. So legal fees paid to establish a right to salary or wages, if that was included in income. So if those wages were taxable and you had legal fees to get those wages, you can deduct a portion of the legal fees on line 22900. The portion is only the award minus the costs. Remember, when you're in court, some of what you'll get is your damages, which is what you were harmed by, and some of it is your costs, which is a fee you get to cover your lawyer. So if you get an extra cost award that says they have to pay you because you had to hire a lawyer, that portion is not deductible on a tax return. Only the part of the fees that are actually in order to collect the money. So in that case, you're going to take the award, you're going to subtract the costs award, make sure that everything they build is connected to the salary or wage issues specifically, and in that case, the fees are deducted on line 22900. You don't have to win to get it. You just have to legitimately be going to court to try to get your wages or your salary. Okay. Then they have fees to get wage loss replacement benefits. So if you have to go to court to get your disability, you can. So notice, this is you trying to get money, you can claim it. If you're the employer and you're defending against it, you can't. Okay, but we're not going to deal with employers in this course anyway, so look at it from the perspective of the taxpayer. If you are incurring legal costs in order to get income from your employment, then you can deduct it on line 22900, again, minus any costs. Legal fees to get a pension, retiring allowance, or awards for wrongful dismissal, but that is limited to the amount that you win. So you actually have to get something then. Okay, but you can carry it forward if you won a partial thing this year and you're going to get more in future years, up to 7 years, not more. You can't have a negative income because of it. Okay. Couple more things in here. The ones that you're definitely going to be seeing are legal fees to collect late child support or to increase child support. Yes. If you go to court to reduce child support, you cannot claim your legal fees. It's only if you're going to increase it or if you're entitled to it and you're not getting it and you go to court to try to get it enforced. Okay? Everything else is no, especially divorce or separation. Custody, if you go to court to get custody, not deductible on your tax return. If you're defending against a civil case, if someone is suing you or you're defending against criminal charges, not deductible. And anything related to property, so if you go to court because of problems when you sell your home, that's not going to be deductible in this sense. It might factor into if you have capital gains. Adoption, we'll talk about adoption expenses in the section on families, and we're going to talk more about this whole custody versus support thing when we talk about families. So we're going to come back to this page. For now, I want you to really get used to the idea that if it's not on the list, you can't get it. If it is on the list, find out which category it is and which line number it goes on. Okay, any questions about legal fees? This is a page to hang on to. This is a very useful page. And we'll come back to this page. when we do families and we start talking about children and dependents, we will come back to this page, and support particularly. Okay, so that's legal expenses. Then we have what's called additional deductions. I'm going to mention them briefly. So if you have income exempt under a tax treaty, remember in Canada we have to report world income. We get taxed on world income. But we have treaties with other countries that say we don't get double tax. So if I have a pension from another country and I have to pay tax on that pension in that country, then I report that pension income here. I shouldn't be taxed on it twice. So what happens is if I'm a resident of Canada, I report all of my income on my Canadian return, and then I'm going to have proof of how much I paid to the other country, and that portion will be a tax credit. I'm going to talk more about that when we get to pensions, but again, fairly briefly, because once you get into really complicated pension scenarios, that's beyond the scope of this course. We're going to talk about it in relation to some American pensions because we see those very, very frequently, and maybe one or two other ones we see all the time. Anything beyond that, and I would say you're going to go find a specialist who can help you. We have treaties with, over 100 different countries, and each of those treaties has its own rules. So again, we get into more specialized scenarios in those cases. The important thing to know is you won't be double taxed, but you have to report your world income. So you report your world income, and then if you had tax paid to another country, and you can prove that it was paid to another country, then you can do a deduction on line 25600. Okay, and then I've mentioned the vow of perpetual poverty. If you have a vow of perpetual poverty and you're donating 100% of your income in the year, you put the income on the income line, and then instead of doing a Schedule 9 and claiming a charitable donation credit, you're going to get a deduction, and it will go on line 25600. Any questions about that? Okay. And again, we'll come back a little bit when we talk about pensions and seniors. Take a break. We're not going to. We've got 10 minutes, and I want to do workers' comp, which is coming up very, very quickly. Death benefits, other income. Not to be confused with the CPP death benefit. It says death benefit, but it comes from Canada Pension Plan. You can, depending on your employer, be eligible for up to $10,000 exempt death benefit from your employer if you die while you're employed. If you see one of these, honestly, you need to go find a senior associate who can deal with deceased taxpayers because there are special rules for deceased taxpayers. But I will tell you that if you have a death benefit, the first $10,000 is tax exempt. Anything over that, you have to add on line 13000. That being said, if you see income related to anyone who died, go get another person to take a look at that return because there's a lot of complicated rules. So this is true unless we're dealing with spousal situations, and then there's some special rules, and you need a whole other course to know how to deal with that. Okay. Other income line has lots of sources of income that are not from employment, and they're not from CPP, and they're not from EI, and they're not from a whole bunch of things. And if they're not from anywhere else, they generally end up here on line 13000. We're going to add a few things to it. What I will say is before you put anything on line 13000, look to see if there's somewhere better to put it, because if it's supposed to be somewhere else and it's being reported on a slip, and most of what we do in this course is coming from a tax slip, if you put it on line 13000 and you miss the correct line, the CRA will look at the tax slip and they will add the income to the line where it's missing, but they won't take it off this line, and then we've double taxed our client. So always look for the best place to put it, and if there's nowhere else to put it, it's probably going to end up here. Couple of things we'll see: apprenticeship incentive grants. These are grants, they're money from the government in order to be able to go to school to work in a trade. The types of trades, if you're curious about it, they're called Red Seal trades. And you can actually Google online Red Seal Trade Canada, and it will give you a list of all of those trades. And we're thinking about things like mechanics, electricians, plumbers, carpenters, all kinds of different trade organizations. And if you didn't know, now you do know that there are some grants to help people go to school to learn how to do those trades. They have one which is $1,000 per year, taxable, and it goes on line 13,000. And they have a second one for women, which is a little bit more, also taxable income. You'll notice there's no tax withheld, and it goes on line 13,000. Okay, so if you have the slip, you put it on the line. They have an apprenticeship completion grant. These are for people who went into a trade they probably were eligible for the grant while they were in school. If they finish their program and they graduate, they can get an additional $2,000 when they graduate. And again, that goes on line 13,000. Okay. Gains from theft or embezzlement. Gains from theft or embezzlement is reported on line 13,000. If you have not heard about it in the news, you might have heard about a recent case with the police headquarters in Winnipeg and the bribery scandal with the things. And there has been at least one person who was found in a civil suit to have accepted bribery income, which is theft or embezzlement income. And what did the CRA do in that case? Does anyone know if you've been following the case? What happened from a tax perspective once they lost their case in court? They're appealing now, but we're in the middle of that. What did the CRA do for their return for 2011? They reassessed them for the unreported income, because that bribe was unreported income. So the CRA very helpfully put it back on line 13,000 for them, and they're going to have to pay tax on it now. They are also appealing that, but if you're curious about it, there are a couple of articles, and you're welcome to look it up to see what happens. That is income from illegal activity that is taxable, and they are being taxed on it now. So that's kind of a very relevant to today case where we can see the CRA and how it works on a tax return happening in real life. All right, so if you have that type of income and you have to put it on a tax return and there's nowhere else to go, that's where it's going to go. Okay. And I know predominantly people aren't going to report it, but I will tell you, I had a client who had some income where they couldn't really classify it as business income because they could get in trouble if they had to come up with a category for what they were doing. And we put it on line 13,000 for them. So they did report their income. Doesn't come up very often, but it does. All right, now we have a federal income support for parents. This is relatively new, but basically all you need to know is if you have a slip with a T4A and a box 136, put it on that line. Notice again, no tax has been deducted from it. And then other. If you can't put it anywhere else on the return, but it is reportable and it is taxable. So some things are not reportable and are not taxable. Inheritances are not reportable and not taxable. But if it needs to be on a tax return and it doesn't fit on another line, that's what line 13,000 is for. Okay, and I have 5 minutes left. Canada Workers Benefit, I think I can do it. And Brittany, does the CRA report to the police for something on that line? No, because there's lots of things that can be on that line, some of which is on a slip and some of which isn't. And also there is an agreement that the CRA says that they do not disclose information to the police without a warrant. So the police would already have to know that there was a problem in order to go looking for it. And they do that because it is beneficial for everyone, for people to pay tax. So if you are making lots of money, it is good for everyone if everyone is paying tax. So there are some sort of protections built in there. All right, Canada Workers Benefit is a refundable credit. Refundable credit goes on a 4 number. It is available for working low-income individuals and families. So if you are low income but you have working income means income from employment or from other employment income, okay? In that case, you get a little bit of extra money from the government. There is a disability supplement. I'm only going to talk about that when we get to the chapter on disabilities because I haven't taught you what a disability is for the tax return purposes yet. But know that if you are a low-income individual and you or someone in your family is disabled, you may get additional money on top of the regular benefit. It's calculated on Schedule 6. We're going to look at a Schedule 6 in detail when we do the review problem, okay? And it's claimed on line 45300. You can request to have your Canada Workers Benefit paid in advance if it is predictable. If you know for a fact what it's going to be, and you're sure that you know what it's going to be, you can apply to have half of it paid up front. That's very rare, so most of the time we don't see this. If you do see it, go back to your textbook and look at the rules for that. The general rule is if your client has received Canada Workers Benefit in advance, they are the one who has to claim Canada Workers Benefit. It is a family claim, but the person who got the advance payment has to be the one reporting it or asking for it on their return. And if you have an advance payment, you report that on line 41500 in Part C of Step 5. That's where it goes. The real thing that I want you to be able to do is calculate it, okay? To claim it, you have to be resident in Canada for the whole year. Everyone in this course will be, so you're not going to deal with part-year residents. You have to have earned income from employment or self-employment, so you have to have earned income. And you have to be either 19 or have a spouse or have a child living with you. So those are the requirements. You're going to notice that the requirements for GST, the requirements for other benefits are going to start to sound similar. I want you to keep them separate in your head. Every refundable credit has its own set of rules. Every refundable benefit has its own set of rules. Don't mix them up. They start to kind of get mixed in your head, and then you start to get confused as to who can claim what. Anytime you're doing a refundable credit, look up the rules for that specific credit. Okay, so 19 or older, resided with a spouse, or lived with a child. Okay. If both of them qualify, pick who's going to get it. You can't split it. It's one or the other, not both. And if one of them has advance payments, they have to. If one of them has disability, they have to. If both are entitled to disability, that's the only time they're each going to get a Canada Workers Benefit. One will claim all of it and their supplement. The other person will claim just the supplement for themselves. That's the only time when it gets messy. We'll talk about that more when we get to families and disability. So again, we're going to come back to this. I want you to be able to do Canada Workers Benefit for single people at the end of today's class, which we're almost at. Oh, we're at 12. We're going to take, if it's all right, we're going to go about 2 minutes over because I do want to get this done, and I'm almost done. All right, so anyone who is enrolled as a full-time student for more than 13 weeks in an eligible program, for now I'm going to tell you eligible program means university or higher. So university or college, not high school. High school doesn't count. Okay, so if we say university or college, full-time more than 13 weeks, we'll come back to this when we talk about students, but this is important. You do not get Canada Workers Benefit. If you are in prison 90 days or more, you do not get Canada Workers Benefit. And if you are exempt from income tax, you don't get Canada Workers Benefit. That one you don't have to worry about. If you have to go, that's fine. This will be posted, and I will do a quick review at the beginning of next class as well, because I know that we're going a little bit over. Okay? That's it, Canada Workers Benefit Schedule 9. Okay, we will do the review problems at the beginning of next class. I'll talk about the assignment next class. If you're nervous about it, don't worry. We will have time. Make sure you've done the review problem chapter 7-2 for next class, and do not open your assignment in ULearn until you have finished the fillable forms in the case. We did it, 12:01, 1 minute over. Okay, so welcome back. We're going to finish the end of chapter 6 right now. We're going to do a little bit more review on Canada Workers Benefit because we had to do that very quickly and it is difficult. And I wanted to highlight a few things there as well that we weren't able to look at. We're going to do the chapter 6 review problems. Then I'll talk briefly about the assignment. We'll take a break and we'll jump into chapter 7. So I'm going to share my screen. And what you should notice on my screen right now, I have pulled out for you a Schedule 6. So just a quick reminder of what we had done in the last class. We discussed who was eligible for Canada Workers Benefit. There are different rules for every non-refundable credit, so you have to not get them mixed up with the rules for other things. This is the part where we start mixing up all the rules we have. So one of the tools we have to make sure we're using the right set of rules for this credit is the form itself. At the beginning of the form, it will tell you who is eligible. You must be resident in Canada throughout the year. You have to have earned working income, and you must be 19 or older, or living with a spouse, or living with your child. Okay? And you cannot claim it if you were enrolled as a full-time student for more than 13 weeks in the year, unless you did that while also having an eligible dependent. Again, we're going to teach you the rules for eligible dependent later, but for now, I want you to know, just generally speaking, think of that as single parents, and we will clarify and solidify that. We will come back to this when we get to the section on families. Okay. There are some special rules for spouses that are considered eligible spouses. We'll come back to that again. But if you need the rules now and you want to know, they are also in the form here. And the form itself, you're going to fill in. If you hit no's for all of these, then you're not doing a Canada Workers Benefit. So that's the first thing. So you must at least be wanting to claim the basic Canada Workers Benefit. If you don't have an eligible dependent, eligible spouse, at this point in the course, you will not have those because we haven't taught you how to do that yet. But for the ones that we're doing, you will we'll be building in later on and adding more to this form as we go. Again, disability tax credit, I will teach you when we get to medical expenses, and then you'll know what that is. And disability tax for a spouse as well. The last one, choosing to include tax-exempt income, we're not going to do in this course, but that does become relevant if you're working in an area that has a lot of First Nations or status individuals who may have income that falls under that category, so that would be covered in a separate unit as well. Family working income, it tells you on the form what counts as working income. So we have employment income, and income from line 10400, other employment income goes there. Some of this, taxable scholarships, fellowships, bursaries, we'll talk about when we get to students. Self-employment we're not going to do, and working income that's tax exempt because of working on a reserve we're not going to cover, but the first two categories will be relevant in this course. That gives you working income figure for yourself, and then if you have an eligible spouse, you'll do the same on the right to get family working income. Your family working income must be more than $3,000 unless you have a disability. If you have a disability, it must be more than $1,150. So again, although Canada Workers Benefit is difficult and there are a lot of rules, the form will walk you through those rules step by step. We calculate adjusted net family income, and this is where it gets more complicated this year than in previous years because there is that secondary earner exemption. And if you find this a little bit confusing, I will say I think the textbook has done a very good job of discussing it. So I'm going to pull the textbook up. I can remember where I put it. Here it is. And show you that we've actually given you a really nice example of how the secondary earner exemption works. Essentially what we're doing is we're looking at a family that because of their family income is too high to qualify for Canada Workers Benefit. Starting in 2021, we have the option of reducing their income by a set amount to a maximum of $14,000 that will allow those individuals who are still a low-income family, just not quite as low as would have been needed to qualify, they can reduce some of their working income. And what it means is two people with low incomes who have some sources of income that are not working income, but both of them do have some working income. It's going to help them access this refundable credit a little more easily, which is going to encourage them to continue to work so that they're not penalized by going to work and losing tax credits. So there's a really nice example in here of how that's going to work, and you can see how the calculation will take someone who would not have been eligible for Canada Workers Benefit and make that family eligible. The last resource that I didn't have time to talk about, but I really want to make sure you are aware of, is in your Facts and Figures book. So if you haven't looked at your Facts and Figures book yet, please go. It is wonderful. It has really good thresholds. So anything you need with numbers on it sorted out in one useful chart, lots of that is in there. We also have checklists. We're going to be using several of them in this class. And the first useful checklist is the Canada Workers Benefit. So in order to know if someone's eligible, all you have to do is pull out this checklist and answer the questions. If you hit a gray box, the answer is no, they're not eligible. If it's white boxes all the way through, then they will be eligible subject to their income. So then you have to look at their working income and their net income. It's also going to help you know who has to claim it if you have to make that decision. And they're going to remind you about the secondary earner exemption down at the bottom of the form. So the way this works is you're going to go through, if you have a client who you think might be eligible for Canada Workers Benefit, you can say, were they resident in Canada throughout the year? Yes. Were they 19 or older? If yes, you can keep going. If no, then you need to tick one of the other two boxes. That'll give you a yes. Then you're going to ask if they were tax exempt because they were an employee of a foreign government. You're going to say no, we don't see a lot of those. You're going to ask if they were in prison. If the answer is no, you can continue. So in prison 90 days or more. We're going to hit the full-time student. This one's fun because if you say yes, you're good to go. If you say yes, you have to go to the next question, which is, do they have an eligible dependent? If you say no, you hit the box. If they were not enrolled as a full-time student, they can continue on. So it's kind of like a flow chart to sort of guide you to the right answer. And then you won't be doing deceased taxpayers, but if they were deceased, there's a date by when they have to stay alive and in order to be eligible for Canada Workers Benefit. So that is outside the scope of this course. When we get into dependents and spouses, we'll have another set of rules there, and this checklist will help you with those rules as well. I will tell you, I do this checklist all the time. If I see Canada Workers Benefit on the return and I'm not expecting it to be there, so for me, I have enough experience now. I have a pretty good sense of who should or who shouldn't be getting Canada Workers Benefit, but I'm not perfect. So if I see a Canada Workers Benefit and I wasn't expecting one, I'll pull out my checklist and I'll double check. And similarly, if I think there's supposed to be a Canada Workers Benefit for a client and I'm not getting one, I'll pull out my checklist just to see if I'm missing something, because it's a way to find out if the computer program is wrong. We have to remember, because tax changes all the time, the computer programs that calculate tax in the software also change all the time. So I can tell you there was a really big error that came across all tax programs for a couple of years. It lasted at least 3 years before it got solved. And this includes the net file services, the free net file services, the professional net file services, and even our software, where for a couple of years, students who were full-time students, because they were full-time students, they were not eligible for Canada Workers Benefit. The software would give them the benefit if they had a disability, which was not what the rules said. So if you did those returns and you relied on the software, and the software says you get Canada Workers Benefit, so you must get it, you would be telling your clients, oh, you're going to get a nice big refund, you're getting some Canada Workers Benefit disability supplement, that's great. And then the return would be processed by the CRA, and the CRA knew that that was not allowed and would not give them the big refund. And the clients would come back and say, what happened? So in those years, if you knew your tax theory really well, you would calculate the return, you'd see a Canada's Workers Benefit, and you go, wait a minute, my client's a full-time student. I don't think they're supposed to be getting this. You go back into the checklist, you do the checklist, and you go, were they a full-time student? And you say yes. Do they have a dependent? No. You'd hit the gray box, you go, wait, they're not supposed to be getting this. And we actually had to look into it, and for several years we had to do an override to take that benefit out because the program was giving a benefit that the client was not entitled to. So you should never rely on your software. You really need to know your tax. These checklists will help you with that. I can reassure you it has been fixed, but remember, every time new things come in, so now we have this new secondary earner exemption, you should be checking to make sure that it's being handled correctly. Okay, any questions about Canada Workers Benefit? I think because it's confusing, if you hadn't yet found the checklist, it can be stressful. But with the checklist, you can be pretty confident that you know when you should be using your Schedule 6 and when you shouldn't. Okay, let's do our review problems then. So I'm going to go into Chapter Review Problem 6.1, and we're going to take a look at Andy. Again, double check the birth date just in case there's some special rules you need to think about, proration and that kind of thing. We don't have to worry about it here. I'm going to put Andy in Winnipeg for me. You're going to put Andy where you live. We have a federal political contribution. What will we do with the federal political contribution? Is it a donation? Where will it go on the form? Do we throw it in the garbage and say you can't use this? It is a federal political tax credit, so it is not going to go on a Schedule 9. It's going to go on a federal worksheet. And in this case, it's $125. How much of the credit will he be allowed? So how much of that will he get back as a non-refundable credit? It's $125. It's under $200. He'll get 75%. Excellent. So this happens all the time, and I've seen this happen in offices. We get into the habit, once we know charitable donations exist and Schedule 9s exist, we start treating every receipt that's a donation as a charitable donation. This is not a charitable donation, it's a political contribution, and he'll get more for it if he puts it on the right line. Okay. Now, Andy had a rough year. This is something I want you to think about. When you're doing actual tax returns, if you were to get Andy's tax slips, you would be getting a workers' comp slip. You know he was injured at work he was injured and off work for a period of time. You know that he was receiving some COVID benefits, so he was probably out of work for a period of time while he was on those benefits as well. And you know that he had some T4. So you're going to say, wow, you had a really complicated year this year. And he's going to say, yes, I definitely had a complicated year. This is what happened. I was laid off in April. I applied for CERB. I got back to work in August. It's crazy. Very shortly after I got back to work, I was injured on the job, had to go on workers' compensation. And it was a whole thing. And you're going to go, oh my goodness, you're going to have some empathy for your client, and then you're going to sort out his tax return and make sure that you're dealing with that income correctly. One thing you might ask if you know he was injured on the job and he had workers' comp is, was part of your income from a working disability plan, from an employer's disability plan? You might ask if he had a wage loss replacement income as part of his T4. So these are the things, when you look at the slips, you have to think about the person behind the slips. Okay, he didn't have a wage loss replacement plan, but he did get the workers' comp, so we're going to handle all of that. And he had tips, 15,300 in tips throughout the year. Before I even do his return, I'm looking at the tips, which is going to go on his return. I'm looking at the CERB, 8,000, which is going to go on his return. And do I think Andy's going to get a refund this year, or do I think he's going to owe? Okay, Bo says he's going to owe. Keen says, oh, I agree. He's almost definitely going to owe. Unless there's another big surprise in there for me, I'm expecting him to be owing. I'm going to start the conversation with him at this exact moment. I'm going to say, you've had a really rough year. Have you ever had a year like this before? He's going to say no. I'm going to say, okay, there's a few things you need to know. Those tips, you might have dealt with that before. We'll see what happens on the return, but you have to know that tax hasn't been deducted off them. That's going to usually increase what you have to pay to the government. And the other one that I'm seeing is the CERB. Are you aware that that is taxable and that tax was not withheld on that? And he might not know that. I'm going to say, so I'm expecting this year, before I even do your return, you might be owing money this year. We're going to see what we can do. I'm going to put in everything I can. We'll make sure you get credit for as much as possible. Just want you to be prepared for that. So he's not sitting there for an hour while you're doing his return expecting to get a big refund, because that's not a good surprise if you're expecting a big refund and you end up with an amount owing. All right, what else have we got? We've got some slips. We have some donations. Salvation Army, Red Cross, Alzheimer's Society, local church. Local church, ordinarily, I would say look it up. I can tell you from doing taxes, looking up Salvation Army is allowable, Red Cross is allowable, Alzheimer's Society is allowable. We're going to assume for the purposes of these exercises that the local church will also be a valid charity. All right, he had an inheritance, a coin collection, and $5,000 in cash. Does he need to do anything related to that for his tax return this year? No, doesn't go anywhere. What does he have to worry about in the future? What will happen when he sells his coin collection? Someday in the future, if he sells the coin collection, he'll have to report capital gain or capital loss. In order to report capital gain or capital loss, he'll need at that time to know what the coin collection was worth today. So it is a good thing to tell your client, hold on to the value of your coin collection, keep a record of that somewhere, because when you sell it, you're going to have to deal with it on your tax return. And it can be hard to go back and find that. If he holds on to that coin collection for 30 years, it's going to be harder in 30 years to know what the coin collection was worth in 2021. So that's something you can tell him about and say, you know the coin collection is worth $15,000 now. We don't need that information for today, but keep it somewhere with your coins so that when you sell it, it'll be dealt with capital gains. And Helene asked, worth according to whom? So when you have inheritances of assets like coins or antique furniture or other things of that nature, you usually get them evaluated, and that would be done through a specialist. So it'll be a coin collector who will look at it and say, if this was to be sold today, what would we get for it? If it was being sold at auction, if it was being sold through a private collector, and they can give a value for it today. And that usually has to be done for probate anyway. So probably he had a valuation given to him already. If he didn't have one given to him, you might recommend he get one now. But we don't need to put it on the tax return. So for you, you can put a line through that and say, I don't need to worry about it. For me, I like to make sure my clients are prepared for what will happen in the future. All right, he's a Canadian citizen, wants to answer yes and yes, does not want to register for online mail, and doesn't own foreign property. He's not going to make an election for his tips for CPP. And we're going to do provincial forms. Workers' comp, remember, is going to go in two places. It's going to go on as income and come off as a deduction. Make sure you do both at the same time so you don't forget. Service Canada, we're going to have other income. And Brittany, if he sells just one coin but doesn't have an itemized list for what that exact coin was worth, I will say it's not very common. If it's a set that has value as a set, people usually don't sell just one of them. Also, usually if they are individual coins that aren't valuable as a set, you'll usually get a breakdown. So he usually will have an itemized list. And worst case scenario, if he doesn't keep it, because a lot of people don't keep things, then when he sells it, he'll have to get the expert who is selling it to also give him a valuation of what it would have been worth on its own at the time that he acquired it. So there's lots of different things that can be done for that. But mostly take whatever information you have about the value now. If you don't have information about the value now, get something in writing and put it in with your coins so that when you do something with those coins in the future, you have the information you need. All right, so we have some CRB benefits, so we're going to put that in on line 13000. Don't forget that he had some tax deducted. We're going to factor that in as well. Looking at his T4, I can see he had registered pension plan. I can see he had a box 46. What do I do with the box 46? Box 46 on a T4? Schedule 9. It is a donation. We don't need an additional receipt. It goes straight onto the Schedule 9. If you missed it, you're going to have to recalculate not only your Schedule 9, but all of the rest of your forms. So everything on the federal form from donations down, and your provincial form, because it's going to change your provincial donations. So when you are doing your schedules, anything that's going to go into the return, triple check before you finish that you didn't miss one. I do know the pain. I have the same feeling when I've done a really complicated tax return and I've asked the client every question I can think and I've got everything sorted out on their desk and there it is. And then the client says, oh, and also we're about to finish. We've been there for 2 hours. They're about to sign everything. They go, oh, I also have this slip and I don't know if you're supposed to see that. And it'll be something that I was not expecting. And all of a sudden it's like, oh, okay, that changes everything. And then you just do it again. That is what we do. I think, Nancy, you can tell me, have you had the clients where they give you everything one piece at a time? They sit behind their desk and they hold their stack on their lap and they go, you can have this now. And I just want to have everything and just sort it my way. But you know what? It's their information. Yep, Nancy's agreeing with me. She's nodding. We've all had those. It's their tax return. You're going to do their tax return at their pace and make them confident that you haven't missed anything. Fortunately, it's a little easier with those clients now that we have tax software. Okay, but it does still change everything sometimes. So, yeah, it's fun. All right, so I got off track. I apologize. So we're on the T4. We're looking for what we need. We're going to make sure we're double checking Canada Pension Plan Schedule 8 and a T2204. And we have some donations, so you're going to circle donations. All right, how does he report the CRB income? On line 13000. And not the income, but if I had to ask the question, what do we do with the box 22, we make sure that we give him credit for the tax that was withheld. What's the difference if he'd received it on a T4E as EI income? So if it had been CERB, he might have applied through EI. In that case, there's two differences you need to be aware of. The first is it would have been reported on a different line because it would have been T4E box 14. So it would have been reported on line 11900. It'll be taxed the same way, but I want you to remember the clawback for EI, the threshold for EI clawback is different than the threshold for CRB. So what is the threshold for CRB? When do you have to start paying CRB back? If your net income goes above what? 38,000. So in that case, he would have to start paying it back. What's the clawback for EI for 2021? Roughly, you don't have to give me an exact number, but what ballpark are we looking at for clawback on EI? Net income over? It's more than 38,000. How much more? Let's see who can find the clawback for EI fastest. There we go. So over 70, I would say, in my head. 73, 75, something like that. Over 70,000. So very big difference in clawback if it had been paid through the EI program and not through the COVID benefits program. All right. Is it going to need to be clawed back? To answer that question, we need to know his net income. I haven't showed you his net income yet, but I have done the program myself, so I can tell you his net income is over 38,000, but not if you take the 8,000 CRB off. So we're looking at net income not including CRB. His net income not including CRB is under the 38,000, so he does not have a clawback. You can reassure him he will not have to pay the CRB back, which is good news for him because he had a rough year. So he's going to owe tax, but he's not going to have a COVID benefit clawback. How will he treat the inheritance? We've talked about that. Nothing shows up on the return this year. When he sells the stamp collection, he'll have a gain or loss, and he'll need to file in that year. How are his tips reported? I hope you all agree that he needs to report all of his tips, and he should have records of when he got them and how much. And it goes on line 10400. For the donations, I'm going to show you the list. All I'm going to say is don't forget box 46. Where can he claim the contribution to the Liberal Party? Line 41000. And make sure you use your federal worksheet to calculate it. All right, let's take a look at his return. I'm going to do this pretty quickly. Andy Van Holt, I've put his address in. I have his SIN number and his birth date, and he's single. He's going to speak English. Province or territory is Manitoba, and he doesn't have a spouse. We're going to say yes and yes. We're going to say no. Income 14.4. as from employment. Tips 15.3. Already I'm thinking he's going to owe tax. Now I'm going to find out how much tax he's going to owe. Serve is $8,000. That's another thing that's adding money that didn't have very much tax deduct. It had some, but not much. So right away, I can say $37,700. If the only deduction he had was at his tax bracket for $14,400 plus another $10 for this, he's going to owe this year. And workers' comp. Workers' comp goes on line $14,400, gets carried over. Total income $41,800. Now I can do deductions, pension adjustment. Don't forget to write that in. We need that when we get to RRSP limits. Registered pension plan deduction will affect his return, so he has the deduction there. CPP deduction. If you didn't get $54.50, go double check your Schedule 8. When we do a Schedule 8 for him, don't forget your 12 months in Box A. What do we get? So we're going to do this, and we're going to say $61,600, $14,400 minus the base amount. His actual total contributions were $696.72. His allowable contributions were only $594.05. So he overcontributed by quite a lot. Because he overcontributed by quite a lot, we have to be extra careful. We should do it anyway, be accurate on your returns. But in this case, you're going to notice his required base contributions is a lot lower than his actual, and his required enhanced contributions is lower than his actual. Give him the nice big refundable credit. Okay? If you missed that, this is why we do a Schedule 8 every time. Remember, most employers, if there's only one employer, will get the will get the Canada Pension Plan, CPP, almost exact. However, it's different if there's multiple T4s. It's also different if there's a chunk of the tier when you weren't working. Because of the way payroll usually calculates CPP, they take more off at the beginning, they take less off at the end. Adjustments will happen throughout the year. He was off work from April till August, and then he was off work another chunk in October. So his CPP calculations will not necessarily be perfect. So you should be putting the 102.67 on. You should be putting the 539.55 as a credit and the 54.50 as our enhanced amount, which I'm going to go back to here. Okay. Add everything together, 424.50. Net income before adjustments, 41,375.50. I'm going to stop there because I have to think about the clawback for CRB. I look at the net income, I reduce it by the CRB, which is $8,000, and I want to make sure that number is under $38,000. In this case, it is, so I can keep going. We have a net income of $41,375. We're going to take the workers' comp off because it's not taxable. His taxable income is $37,275.50. Okay. Now we're in the lowest tax bracket federally. His federal tax is $5,591.33. Give him some credits, $13,808. Base CPP is there. If you've done a T2204, you know that he can claim $227.52 of his EI premiums. Give him the Canada employment amount. He qualified for it. Add everything together. He gets $15,832.07. We're going to take 15% of that, gives us $2,374.81. And now I know he had donations. I'm going to stop and I'm going to make a list of his donations. So the list of his donations should be Salvation Army 160, Red Cross 350, Alzheimer's Society 180, his church 1,080, and his T-slip donations of $87. Add them together, and the amount that we can put on line 1 of the Schedule 9 is $1,857. So I'm going to do a Schedule 9. It goes on the first line because it's all cash donations to registered charities. He can claim up to 75% of his net income, which is all of his donations. There's no limit to how much of them he can claim here because his net income is high enough. So we're going to put all of that in on line 10, stays on line 12, and then we're going to subtract 200 because remember the first 200 we get a lower percentage, and the remainder is 14. The rest of the calculation here is to tell you whether he's in the top tax bracket or a lower tax bracket. Essentially, all they're doing is they're saying, is he going to get 33% or 29% on the bulk? He's going to get 29%. So 29% of 1657 is $480.53. 15% of the $200 is $30, and altogether he gets a non-refundable credit of $510.53. And we definitely want to use it for this year because we know he's going to owe tax for this year. He's getting a pretty good chunk back. There's no reason to pool it and save it for the future. We're going to put it on the return for this year. All right, so I can go back to here. I can add that in, and his total non-refundable tax credits federally, $2,885.34. I'm going to take the federal tax, remove the non-refundable credits. It's going to leave $2,705.99. Then I'm going to do a federal worksheet. I won't show you that. I assume that that's an easy one to calculate when there's less than $400 basically. So 125, he'll get 75%. You do have to do the worksheet if you're doing a paper return. If you don't give them the calculations in the format they want, they will not give you the credit. All right, so $93.75, and that leaves his net federal tax at $2,612.24. That goes on to step 6, and then we have to do provincial. Provincial, just before I forget, I'm going to do the family tax benefit. He's close, but he doesn't get it. If he had a larger family, he would. Let's do the actual provincial form. We have taxable income. Notice he's in the second tax bracket in Manitoba. He was in the first tax bracket federally, second tax bracket in Manitoba. So his Manitoba tax is $4,095.02. He's going to get the basic amount in Manitoba, CPP and EI, and that's it. 10,703.07 times 10.8% gives us 1,155.93. And then the donations, it's nice we calculate them right on the form. We take the numbers from the Schedule 9. So you have to have your Schedule 9, $200 at 10.8%, the remainder at 17.4%. He'll get another $309.92 non-refundable provincial credit. So his total provincial credits are $1,465.85. I'm going to take the tax owing minus the credits, and he'll be paying $2,629.17. You should still do an MB479. If you do an MB479 with the base credit being $195, he will not be eligible for it, so he won't get a refundable provincial credit. Go back to the federal tax return. Federal tax plus provincial tax, total payable $5,241.41. You're going to notice he had a lot less than that deducted at work, so he is owing, but we were expecting that. Okay, CPP, he gets the refundable credit there. We're going to add that in, and we should end with a balance owing of $2,526.56. Now, what would you recommend for next year? So next year, he may not be on workers' comp again. He might still be on workers' comp, and that's something to think about. But let's assume he's healed and he's back at work. What would you recommend for him for next year? Because he doesn't want to have to pay more. And Helene, you says extra tax taken off. That's the first thing I would do for this client. I would have him take extra tax off because he knows he's getting a lot of tips. All right, Karina is going to recommend RSPs. You're correct. RSPs would give him a tax break. When we get to RSP section, I'll explain why it might not be the best choice for him. So RSPs are an option. They would give him a deduction, but it's not a very valuable deduction for him because he's in the lowest tax bracket. So in his case, it might be better to have a bit more tax taken off at work, or what he could do, and this is another option, if he has a tax-free savings account set up, he could save some money off every paycheck and invest it in that tax-free savings account. And then he'll know he's going to owe next year, but he'll have prepaid his owing to himself, and he can make some money on that money that he's putting aside in the meantime. Anything left over, he considers his own refund. So I would recommend those two things first. And of course, you can show him that his donations are helping him. So if he's still donating next year, that will be beneficial to him as well. Good. Whew, that was a lot. That's one. We're going to go in and we're going to jump straight into the next review problem. which is Lucy Capello. Brittany, you're annoyed. You had the 8,000, but you didn't include it. Yep. Now, the good thing, every time you make a mistake on a tax return, you learn something from doing it. So every time you make a mistake on a tax return, you have to recalculate. It is one more chance to practice recalculating. And I know that's frustrating now, but it's worth it when you get and you've done a couple more of them and you get to your assignment, which we're coming up on. So, but I feel your pain. I did this course too. I have learned strategies to triple check before I move on every line all the time because it gets very frustrating for me too. All right, here we have Lucy. Lucy is single. Take a look at Lucy's date of birth. Okay, Lucy is single but young. Lucy just finished high school. Okay, a couple things to think about there. She's working as a sales clerk at the local supermarket. She has a T4. She did make some donations and she has receipts for Cancer Research Center. That one will be valid. Food bank will be valid. And the city church, in this case, we're going to say is valid. Okay. Lucy has never filed a tax return before. She'd like to receive her notice of assessment in the mail. Lucy's a Canadian citizen and would like to answer yes to the Elections Canada question. We're going to look here, and if you forgot to check, she does have a box 46 with $25. Don't miss that one. Let's answer some questions. Can she claim all her donations? In this case, if you've done the rest of the return, you'll see that she still owes both federal and provincial tax. So it is beneficial for her to claim her donations now. That being said, keep an eye out for people with low income making donations. If they're only saving federal tax, but they're not saving provincial tax, and that does happen sometimes depending on their tax bracket and how much it is, you might choose to save those donations for the next year. Even though you pay little federal tax now and the donations might make that go away, you're losing out on the extra provincial credit. So if you're only going to save federal and you're not going to save provincial, it's probably better to pay a little bit of federal tax now and get more benefit from that donation next year. This year, we're going to claim them because Manitoba has a very high tax rate, so she does need to pay both provincial and federal tax. Okay, we're going to do her calculation for donations on the schedule, and we're going to take a look at Canada Workers Benefit on the schedule, so we'll do that together. Now, Brittany, you said you're nervous that you haven't gotten anything right. The assignment doesn't only ask you one question, what is the final answer? So it's going to be testing, did you put things on the right line? So even if you have a few math errors here and there, you will still get credit for all the hard work you've done. Try not to have math errors, so take your time, review it. If you really need to, have someone else double check your math for you. That's perfectly fine. But don't worry, you are being tested on your knowledge, not just did you get the right answer at the end. Try to get the right answer, but we will give you credit for the work that you are doing. All right, let's take a look at Lucy in the tax return itself. Okay, so I'm going to go find my Lucy. Okay, and the very first thing I want to do with Lucy, because I know we're doing a Schedule 8 for her, double check her age. And when I double check her age, I can see that she is old enough to qualify for CPP the whole time, but she's close enough that I would have looked that one up. So we have Lucy, we have her birth date, we have her SIN number. She's in Winnipeg, she's single. Manitoba, province of residence. We're going to say yes and no. Income, fairly straightforward, $17,850. No additional sources of income, so that's her total income. Deductions, we're going to get to CPP, and we're going to do our Schedule 8. Schedule 8, we double checked. There's no proration in this case, but if she'd been a little bit younger, there would have been. Okay, $17,850, pensionable earnings minus the base. Okay, $845 was the actual contributions. $782 was the allowable contributions, so she does have an overpayment. So we're going to give her credit for her overpayment, $63.60, and we're going to take the smaller numbers for our required enhanced amount for the deduction and the credit. And don't forget to do a T2204. Okay, there's her deduction. Net income 17,778.25. As soon as I get to here and I'm looking at the fact that she's working, I'm thinking Canada Workers Benefit. So just so you know, I'm already thinking about it. When we get to that line on the tax return, we'll do the schedule. Okay, no additional deductions, so there's our taxable income. Let's get her taxable income done. She's in the lowest tax bracket for sure. Most of her income will not be taxable because she has a very large personal credit and a very low income. So we're going to start with her 13,808, and then we're going to add in her CPP and her EI and her employment amount. And you're going to notice her non-refundable tax credits are pretty close to her total income. So I know if she had tax deducted, she's probably getting a refund. I'm going to take 15%. Before I do the donations and gifts, I will look to see if she owes any federal tax, because if she doesn't, if she had had just a little bit less income, I would not be putting the donations on this year because I'd be wasting them. If I claim them and you can't use them, then there's no benefit. I would save them for next year. So I actually do this one twice. I get to here, I go down, I calculate whether she owes tax, and if she still owes tax, then I'll go back up and do the donations. So let's do some donations. Which things is she going to be allowed? We have Cancer Research 150, Food Bank 175, Church 255, and her box 46, 605 total. I'm going to do the Schedule 9, 605. She's allowed up to 75% of her net income, which is more than 605. We're going to separate out the bottom $200. She'll get 15%. The rest of it she'll get 29%. And it's total donations and gifts of $147.45. I'm also going to double check her, before I do all of this, I'm going to double check Manitoba to see if she needs it there, because if she doesn't need it there, I'm probably going to save the donations for next year. But in this case, she does need them. Okay, back to here. We're going to have total non-refundable tax credits of 2556.05. And you're going to say, even with that, she owes a little bit of federal tax. She's paying $110 to the federal government this year. And then we're going to get to the provincial. Okay. Provincial, you needed to do a little bit more work. So again, let's think about family tax benefit. If you have been forgetting to do them or neglecting to do them, this was a scenario where you did need it. So if I do family tax benefit, the credit is $2,065. 9% of her income is less than that. She's going to get an additional non-refundable provincial credit of $464.96. So do that one first. Then we're going to jump into the form. She's in the lowest tax bracket. She gets her basic personal amount. She gets CPP and EI. And down at the bottom, she gets her family tax benefit. Her total credits are $11,393.32, 10.8%. Again, I would have stopped at this point and checked to see if she's still owing Manitoba tax. Because she is, we did all the donations. So the donations 200 at 10.8%, 405 at 17.4%, additional credits of 9207, total credits 1322.55, and let's see how much provincial tax she has to pay now. And you should have gotten $597.50. That's going to go on the tax return, but before I leave, we're also going to look at refundable credits. So refundable credits, this is the first time you've seen me do an MB479 on screen. Here I have a 17,778 is her family income. The credit is $195. She's going to reduce that by 1% of her income, and that gives a personal tax credit of $17.21. So we're going to give her $17.21 extra. Now we can go to the end of our tax return. We have $110.69 plus the $597.50, $708.19 is what she should have paid in tax. She paid more than that. She's going to get a refund. CPP refund, We've got provincial refund, and remember I said Canada Workers Benefit, we should calculate that for her. So here we go, Canada Workers Benefit. The rules come first. She doesn't have a dependent or a spouse, but she is claiming the basic amount and she is not disabled. So those are the boxes you're going to fill in for her. We're going to start with her working income, which in her case is also her income. Okay, net income and working income will be the same. She doesn't need to worry about the secondary earner exemption. She doesn't have a spouse. Okay. Then we're going to calculate it. 17,850 minus 3,000 gives us a number times 25%. We have a maximum benefit. Then we have to take whichever is less. We end up with a 0 there. So she's going to get the full Canada Workers Benefit for the year, $1,395. And we're going to put that back on the return. And she's going to get a nice refund of $2,447.63. Okay. This was a difficult one. So if you made a lot of mistakes, see what you missed, try it again, and then send me your answer. And I will look at your answer and continue to correct it until you got it right. What's happening now is you started with a very simple tax return and we're adding pieces in. So you're going to go slowly, you're going to go line by line, and just give yourself a little checklist of everything you have to think about. I suspect that it would be one or two little things, and those one or two little things make a very big difference in the end. And Anna, what order do I complete my forms? Excellent question. I start at the top of the tax return, and I will literally do the tax return in order. So I do the first line of the tax return, the second line, the third line. As soon as I hit a calculation or a form, so for example, when I'm going through the return, I'm going down the lines, I'll get to the CPP Enhanced, I stop right there, and I do a Schedule 8. I do the whole Schedule 8, I take all the numbers, I put them all back on the return, I come back to the line I was on, and I keep going down. So what that does for me is it means that I don't miss anything. If I'm going line by line by line, I hit a calculation, I stop, I do the calculation. It works for me. It might not work for you. You might find another system that works better. I think the reason I do it this way is because tax returns change all the time, but the structure of the return is always the same. We always do income first, then deductions, then in some order non-refundable credits, and then in some order refundable credits. And so in that case, it's a question of whatever happens, the order that I'm doing things is just, it just flows for me, and it's predictable and consistent from year to year. So I do them in the order of the tax return. It keeps me organized. But like I said, you're going to find a system that works for you. You might do it based on your slips. You might go, oh, okay, I have T4 slips, so I'm going to do my calculations starting from what I need to do because of those T4 slips. I know I need a Schedule 8. I need a T2204. If I have donation receipts, you can pull that aside. So you'll find the system that works for you. I like the order of the tax return because from year to year to year, the process of the tax return stays the same, even if the rules and the line numbers change and the schedules start to look different. All right, and Brittany, provincial, if you're not sure, send me what you did provincially, and I will let you know. So I'm here as a resource for that. Okay, I'm going to take 5 minutes. I want to talk about the assignment because I know you're all very stressed about the assignment. So we're going to pause the recording here.